Judge Ryan,
Hey, Mr. Lee, how are you?
good. I don't
Good.
know. I don't know who the keeper of the Dropbox is, but I need the latest version of the exhibits out of whatever they uploaded in Dropbox.
Were you able to use that link that I sent? Did that take you
Yes.
to, was it, or the exhibits weren't there?
No, they were there. I've got but I don't have what was uploaded last night.
Oh, I'm not sure there was anything. I mean, I don't deny that there was stuff that the parties were supposed to put up. I'm not sure if anything was. So I have to, I'll ask Miss Hurst to go over that to see what folks uploaded, if anything.
All right. Yesterday's transcript is complete, but I can't turn it out till I have the exhibits, the complete exhibits.
Okay, great. Let me go talk with Miss Hurst real quick.
All right.
Great. Bye.
Bye.
Hey, Chris, did you talk to Mr. Lee about what we saw?
No, yeah, no, I was just waiting for him to come
Okay.
back. I'm guessing he's in the background there. He'll probably come on in a second.
Okay,
Let's see what I can see.
let's see.
We can date modified. This is the 29th. So yeah, I see what you're seeing, which is the at 4:57 and 4:56 yesterday. They had something from Mr. Wessine, Mr. Sanders, Mr. Jones, and then a exhibit list.
Yes,
Yeah,
and I'm assuming that's what Mr. Lee's looking for.
yeah. Just see if he, Mr. Lee, are you there? He might be have just run to the restroom or something.
Okay.
Testing.
All good.
Okay.
And you already have the YouTube link?
Yeah, we're up and going. And honestly, I sent her the link earlier, so she should have posted that now to the commission's website.
On day 3, it starts to get a little tiring. I don't know if we should have meditation or exercise.
I think we need a coffee delivery is what we need.
Well, I thought you were gonna say like some scotch or bourbon, and I thought, it's the state building and I might get in
Yeah.
trouble.
Well, my doctor told me I had to give that stuff up, so I reluctantly had to agree with him.
Oh, did you have to give up your motorcycle too?
No, I actually just finished a 2-week trip to the East Coast.
Oh, nice.
Yeah, I went all the way to the Vietnam Memorial Wall and back.
Oh, wow.
Went through the Smokies on the way back and in Tennessee and North Carolina. It was amazing. So,
That is pretty amazing,
yeah.
especially so were you actually on the bike?
Oh, yeah.
Or
the whole
were
time.
you trailering the bike and riding
No,
it occasionally?
that's not, no trailering.
That's like car camping, right? As
Yeah,
opposed to tent camping.
it's
yeah.
really not camping. It's just like, it's like you're pretending to be a homeless person in the woods. I know
No,
that.
I know. I actually know some people that do that.
Yeah,
It's like, oh yeah, we went on a trip with the bike, and it's like, oh wow, how was that to ride X number of miles? Oh well, we didn't ride the whole way.
yeah, we went to Sturgis.
We took the bike on a trailer, and then we just rode once we got there.
Yeah. No.
Okay.
No, I had to be in the hospital 3 weeks afterwards, but that was, no, I'm just kidding.
Well, it's, as my mother's always told me, it's priorities and choices. So,
I tell
still have the bike. That's good to know.
Yeah.
Are we going to have any procedural matters that we need to deal with this morning?
Madam Hearing Examiner, I told my witness, Mr. Gorman, that he might go on later today, not right after lunch, or his appearance might be pushed till tomorrow morning, and he's ready
Okay.
for that. So I have him not exactly standing by, he's working on some other projects, but he's ready to
Okay.
go whenever we need to fill in the hearing. It might take a couple of minutes to get it arranged and stuff. But I just
Okay.
want to let you know that. Thank you.
I thank you. nothing from anybody else. Well,
Madam Hearing Examiner, I did touch base with Dr. Moran and he's on standby. I told him we have one witness before him and then it would be probably 30 or 60 minutes before him. And that was just a guess. And so he's ready to go on when we're ready.
okay. All right, very well. And when we go on the record, I will first address the filing of the 3 exhibits, which I see from the Dropbox exchange list, were filed just before 5 last night.
Yes,
Mr.
Mr.
Lee? Yeah, go ahead. Go ahead, Elizabeth. Sorry.
Oh, Mr. Lee, you, Chris and I were talking, and did you find those exhibits in the Dropbox?
Do they automatically upload to the link I have?
The last link you had, so the last one I sent out, whenever that was, the last link, so if you just look for the last email from me,
All right,
that should get you to an updated version. It should be synchronized with whatever's put in there. So
Right.
if that's not the case, Mr. Lee, it won't be hard for me to get you that, a new link, but just let me know when you get a chance.
I will.
I think you sent that link on Monday, didn't you?
Yeah,
I have access to the link, but now that I'm set up, I can't look for it right this minute.
that's fine.
Okay.
Yeah.
Just, Mr. Lee needs the exhibits for the transcript from yesterday, so. Okay, well, I believe, we are at 9 o'clock, so. Just to remind people, we are live streaming on YouTube. So, Mr. Lee, if you're ready, let's go ahead and we are resuming our hearing in case number 21-00267 UT from our recess last evening. I just wanted to deal with a couple of procedural matters. Before we resume the examination of witness blotter, and those procedural matters that I wanted to put on the record this morning were with regard to some exhibits that were offered yesterday, but the actual corrected versions of the exhibits were not in the Dropbox. And my understanding is that the exhibits were in fact loaded into the Dropbox before the close of business yesterday. And I'm sorry, I don't recall Mr. Domi or Mr. Haverly, New Mexico Gas Company exhibit number 12, Mr. Wassein's direct testimony and exhibits in support of the application as correct, and that exhibit as corrected was provisionally admitted yesterday, subject to gas company filing that exhibit in Dropbox. That was accomplished, correct, Mr. Domi?
Yes, ma'am, it was.
Very well. I will take the provisional rating off that exhibit and admit gas company exhibit 12.
Thank you, ma'am.
Additionally, it is my understanding that gas company exhibit 15, the direct testimony as adopted by Mr. Sanders and corrected by him here yesterday, was also provisionally admitted, subject to filing of the exhibit as corrected by him yesterday. That also has been filed in the Dropbox, correct, Mr. Dome?
Yes, it is. Yes, it has, ma'am.
Okay, very well. Again, I will remove the provisional determination on Exhibit 15 and will admit Exhibit 15. And then finally, Gas Company Exhibit 23, the direct testimony as adopted by Mr. Jones, as corrected by him yesterday, also received a provisional inclusion in as evidence. And my understanding, Mr. Dome, is that Gas Company did in fact put in the Dropbox the corrected exhibit for Gas Company number 23. Is that correct?
Yes, ma'am, it is.
Very well. I will remove the provisional admission and I will admit Gas Company number 23. Those are the procedural matters that I needed to deal with this morning. Hearing no other, I believe we can continue with questions for Gas Company witness Blotter. Hearing examiner Ryan.
Thank you. Good morning, Ms. Blotter.
Good morning, sir.
In your testimony at page 6, this is probably a very small matter, but I just want to make sure that I understand. Beginning at line 22 at the bottom there, the sentence.
Excuse me 1 second, sir. Ms. Blotter, you're reminded that you're still under oath.
Thank you.
Very well. Go ahead, sir.
Thank you. So the sentence reads, the reasons for New Mexico Gas Company's revenue deficiency are the capital investments the company is making between January of 22 and the end of 23. And then on the next page it says, and recovery of increased operating expenses. And when I read that, I thought, well, the recovery of expenses can't be the basis for a deficiency. So I assume what you meant to say there is something like, we need to recover those operating expenses in 2023. That's what the import of that sentence is, correct?
Yes, that is correct.
Yeah, I thought as much. I just wanted to make sure that I was reading that. At page 10 of your testimony, you talk about the transactions with affiliates, and you note that 10.3 million in charges and then offsets of 0.2 million. And that's at lines 10 and 11. And then down to 11 through 13, you then describe what you anticipate in the future test year. And maybe it's in later portions of your testimony, but are there offsets that are also calculated here?
The 0.2 million that is an offset that's noted there in the base period would carry forward at escalated rates into the future test year.
Okay. So I listened intently yesterday as you and Ms. Hurst were discussing the corporate and related services that you receive and affiliate transactions. And I guess, I just want to, without focusing on any specific portion of your testimony, I guess what I was sort of puzzled by, I just didn't really understand, like, why are executives being paid from New Mexico Gas Company to Emera and vice versa and TECO? And I guess I was just going to ask if you could please just expand upon that. And I think anytime we hear executive payment, there's sort of always like a bit of a, warning signals go up or whatever. So if you could, for the commissioner's benefit, just talk about those relationships and why is there executive compensation going back and forth?
Sure. So when I think about the executive allocation that we were discussing yesterday, that relates to charges that New Mexico Gas is paying for. Those are an allocation that represent the services provided by Emera executives to us as an affiliate of the parent organization. So when we think about what types of services, if you will, that the Emera executives are providing to the gas company, it would be things related to strategy, to making sure that there's alignment amongst affiliates. I could give a very good example going back to the experience that we had as we entered the pandemic in spring of 20. Situation that was, unparalleled by anybody, any of us going through this, right? So what the Emera executives brought to this was alignment of best practices to ensure the safety of our employees, of our customers. And that ability to bring multiple inputs from the various affiliates, bring that together, combine that with what they're seeing elsewhere in the industry, and provide excellent advice back into our business to help us streamline our response and to, be as close to best practices, in moving forward in better ways than we would have been if it were our executives unaided by the advice and the wisdom of those around us.
Okay, and so as those, I'm just curious, how does one quantify, or like how do you put a number? I mean, I'm aware in legal practice, right? The attorneys there at Kelleher and McLeod, they charge by their hour. I mean, how does that work? How do they figure out how much has been done and what compensation should be provided?
Sure, that's an excellent question. That particular allocator is done on the modified Massachusetts method. So
Okay.
Practically, there is a formulaic approach to how much we are paying for.
And actually, I was hoping you could. I saw the modified Massachusetts method reference in your testimony, and the first thing I did was to try to discern what is that. And therein resulted a Google search, which is hardly the best way to do these things. But in any case, as a first blush, can you expand upon what this is and how that functions?
Yeah.
Yeah. Go ahead.
Let me give just a little bit of a framework of how we approach the shared services first, because then it helps explain that particular portion. So as I talked about yesterday, there is first a preference for direct charging. So anytime that there is really specific work that can be tied directly to a cost causation, if you will, at an affiliate, direct charge is the preference. Next comes assessments. So these are some sort of statistical measure for how those costs could go out. So a function like accounts payable, right? There are cost causers for how accounts payable operates, and therefore we attempt to spread those costs based on those. And then the last approach is the allocated charges, and these are the ones that come through on the M method.
Okay.
And basically, those are, again, shared expenses, but there isn't a direct charge that's available or a very clear assessed methodology. And so then those come through on a way that the modified Massachusetts method essentially tries to differentiate between the size of various utilities and therefore spreads that remaining bucket of costs based on
I'm
size.
sorry, the size of various utilities and their what?
Their size.
Okay. Go ahead.
So it's spread essentially on size because there's not necessarily a better driver for that.
Okay, and it sounds like, if it has, this is a method, this is a well-defined way to apportion costs, I guess, that where it may not be entirely clear how exactly to apportion them. Is that what this tool is trying to do?
Yes.
Okay. Okay, if you could turn to page 16 of your testimony there. And then just, starting at 15 over to 16, these are the various tables you provided. I guess one question I had is the table on 16, table 4, the total, unless I'm looking at an older version, and maybe you've corrected this, I don't know, but that assessed of 95,408, should that carry over into the total category? Because I'm
Yeah.
looking at 69,489.
You're absolutely right. That should carry over. I apologize for that.
That's okay. And the reason why, I guess I noticed that was because when I was looking at this, I'm seeing it's a simple, Scrivener's error as I perform all the time.
I suspect, yes, indeed. If I were to look back on page 15
Mhm.
at the table at the top of the page, table 2, I can see exactly where that 69,489 number came from. So that absolutely is a typographical error.
Yeah. So, but my substantive question really is, all of these costs go up.
Yes.
We look in through the tables and you can see that the costs increasing. And I suppose one question is, I guess with these affiliate services, you all are expecting effectively a constant demand or a constant need. And it looks like the price is basically going up for the provision of those affiliate services. Is that what basically going on here?
I think that that's a fair high level assessment. When you get
Okay.
down into the specifics of each one, there may be slightly different drivers that are going on within each category. But when I think about the shared services, some of those are driven by contracts, and so changes would be driven by contract terms. But some of the charges, a fair bit of the charges would also be related to labor, under which scenario we would likely assume, year over year increases there.
Okay, and that those increases are just is that a consequence of just the cost of labor increasing by whatever factor?
Correct.
Okay, so I guess I'm just wondering, as you projected the future test year and thinking about these affiliate charges, it would be safe to assume you assumed the same degree that you used previously, and then that was the basis, and then you moved forward and said there's probably going to be and I know you just said that, so I just want to confirm I've understood correctly.
Yeah, that is a fair assessment. The one area that might be a little different is related to the TSA charges that are relatively new. So those were items that I know were specifically forecasted on what the levels might be for the 2023 test year.
Okay, and could you remind me what are the TSA, those the things that you just say what that abbreviation is?
Sure. If I could think of what TSA stands for, that would be the governmental department that would be exactly in line with what you would expect it to be. It's basically pipeline security items that the Department of Homeland Defense are requiring gas companies to put on. And this was prompted out of the incident with, I believe it was Continental Pipeline a year or more ago.
Okay.
So there are additional requirements that are there. I believe witness Wilcox is expert on that, and a number of those are coming through IT related.
Okay.
applications.
Okay. At page 17 of your testimony there, I see this is a term I've never seen before at line, it's in that series of the list there, item number 2, secondees.
Mhm.
What is this?
Yeah, so typically we would think of those as folks who are basically expatriates. So these would be individuals who are, in our particular case, Emera employees who are here at New Mexico Gas serving in our business.
Okay, so it says there, wherein New Mexico Gas Company reimburses Emera for compensation Emera provides to 2 New Mexico gas companies. So in other words, Emera keeps paying their salaries and then the gas company reimburses Emera. Is that basic?
Yep.
Okay.
That's absolutely it.
But they're working for the gas company here in New Mexico.
Yes, and they are 100% on the gas company here in New Mexico.
Okay, so is that sort of like did they not intend to remain forever and that's why they are getting paid by Emera?
Correct.
Okay, so they're just kind of borrowed employees for the moment.
Yes, yep.
Okay. At 22, where you're talking about the advertising expenses, hearing examiner Hurst during Mr. Shell's testimony, he made reference in his direct testimony, pre-filed testimony, and I'm sharing this because you'll understand in a moment, about how the gas company has to compete for something. And Ms. Hurst asked him, sir, you're a monopoly. Why would you have to compete? And he explained and clarified, no, what I meant is that people out in the world have an expectation as to what customer service will be like, and we have to stay competitive with that expectation. And I understood the clarification. So I kind of was wondering the same thing with this advertising expenses is why does the gas company need to advertise?
Oh, that's a very good question. If you go back one page to page 21, you'll see a bulleted list of the types of advertising that is permitted.
Okay.
So these could be related to public safety, conservation of energy, explaining our practices to our customers. So you can read through the list there, but those would be the types of expenses that we would be advertising related to.
All right. So in some ways, the word advertising seems a strange word because really what you're doing is some of these items here are more informing your customers of things that they can utilize to their benefit.
I think that's fair. It's communications with them.
Okay. Then that's more comprehensible. Thank you.
Mhm.
And this is a follow-up question yesterday. Ms. Hurst asked you as well on page 25, beginning there at line 16, you talk about what interest rate did New Mexico Gas Company assume for the February 2023 $50 million debt issuance? And without reading that whole line, it looks like 4.3%. And Ms. Hurst asked you, is that a realistic expectation given what's occurring right now? I mean, I can only speak from, as a person who looks more at like mortgage rates and whatever. I know 4.3% would not be a mortgage you could get right now. So that's probably incorrect, 4.3, right?
Yeah, so the most recent numbers that I've seen for a 30-year debt issuance would have the issuance about a full percentage point higher than that. But as I mentioned to Ms. Hurst, there are different things that we could do, such as perhaps considering a shorter term that might shrink that interest rate to be something closer to what's in our cost of service.
Okay.
But I agree with you, overall interest rates are going up.
Right. And it's sort of unpredictable ways, I suppose.
Yes, unfortunately, right?
For us all, yeah.
Yes.
All right. Thank you, Ms. Blotter. That was all the questions I had. I appreciate you coming back and chatting with me.
Thank you, Mr. Herring-Examiner.
Thank you.
Ms. Blotter, just so that the record is clear, the correction that you refer to on page 16,
Yes,
was that corrected in the version of your testimony that was submitted?
no, it was not.
Okay, so basically what I thought I heard you say is that in the table 4, the last descriptive line of legal and related services, the 95,408 should be carried over to the last column total. Is that right?
Yes, that is correct.
And would that then change the total from affiliates total number?
No, so this table is not doing math inside of words. So the 11,650,889 is a correct number.
Okay. So we don't need to add 25,919 to that number.
That is correct. We do
Okay.
not.
Okay, thank you.
Mhm.
Mr. Domain, Mr. Haverly, any redirect for Ms. Blotter?
Madam Hearing Examiner, we do not have any redirect for Ms. Blotter.
Very well. Any questions from any of the parties based on hearing examiner Ryan's questions or my questions? Hearing none. Ms. Blotter, thank you very much. We appreciate your time. You're excused.
Thank you.
And I believe gas company has another witness.
Yes, ma'am, we do. And that's Dr. Moran, and he's apparently, I think, in the waiting room. There he is.
Good morning, Dr. Moran. Just need to unmute yourself.
I am here.
I can't hear that. Can you, I'm sorry, can you say something, Mr. Moran?
Good morning, everyone.
Thank
Good
you.
morning. Go ahead, Mr. Dome. Dr. Moran.
Good morning.
Thank you,
Mr. Lee,
ma'am.
could you swear the witness, please? Unmute yourself.
Oh, we're getting a,
Somebody has their YouTube feed still on, and that's what we're getting feedback from. So
yeah.
if we would just get rid of that, I think we'll be okay. Looks like we did. Okay, Mr. Lee, if you'd swear the witness, sir.
Sir, would you please raise your right hand? You solemnly swear the testimony you're about to give in the matter not pending should be the truth, the whole truth, and nothing but the truth, so help you God?
Yes, I do.
Thank you.
Mr.
Dr. Moran,
Dolan?
Dr. Moran, for the record, could you please state your name, occupation, and title, please?
My name is Roger Morin, M-O-R-I-N, and my title is Emeritus Professor of Finance at the Robinson College of Business, Georgia State University. And I'm also the Distinguished Professor of Finance for Regulated Industry at the Center for Regulated Industry, which I chair. And this is all at Georgia State University in Atlanta, Georgia.
Thank you very much, Doctor. Dr. Moran, you have in front of you two pieces of testimony, and we're going to move now to get those into the record. So the first one is your errata direct testimony, and that is NNGC Exhibit 25. Do you have that in front of you?
Yes,
Doctor, was that prepared by you and at your direction?
yes, sir, it was.
Do you have any corrections to the errata direct testimony that's been placed in the Dropbox?
No corrections.
And is this testimony true and correct?
Yes, it is.
If I asked you these same questions today, would your answers be as written in this testimony?
Yes, sir.
Thank you very much. You also have in front of you your testimony in response to the hearing examiner's June 6th, 2022 bench request. That is NMGC Exhibit number 26. Do you have that in front of you?
Yes, sir.
Do you recognize that document?
Yes, I do.
What was that prepared by you or at your direction?
Yes, sir, it was.
Do you have any corrections to this testimony?
No corrections.
And is it true and correct?
Yes, sir, it is.
If I asked you these same questions on the stand today, would your answers be as written in this testimony?
Yes, sir, they would.
So, Madam Hearing Examiner, with that, I will represent that both of these documents, NNGC 25 and Exhibit 26, are the copies that have been placed into the Dropbox by the company.
Very well, Mr. Domain. You would like to have Gas Company Exhibit 25, Dr. Moran's errata direct testimony as verified by him here today, subject to the no objection agreement and verified that this copy of Gas Company Exhibit 25 has been placed in the Dropbox pursuant to the order. Hearing no objection, Gas Company Exhibit 25 is admitted. Gas Company also requests that Exhibit 26, Dr. Moran's responses to the hearing examiner's June 6th bench request, as verified by him here today, subject to the no objection agreement and the verification from Gas Company Counsel that the correct copy of Exhibit 26 has been placed in the Dropbox, is admitted. Mr. Dome?
Madam Hearing Examiner, on Monday, I moved for the admission of NMGC Exhibit number 4, which is the errata notice to the direct testimony of Roger Moran. And at that time, you indicated that that motion or that, the motion for admission of that notice was more appropriate at this point in time. And so I would renew my motion for admission of NMGC Exhibit number 4 now that Mr. Moran's errata testimony has been admitted.
And for the record, will you describe that exhibit, sir?
Yes, ma'am. That is NMGC's errata notice to the direct testimony of Roger Moran, which was when we submitted the errata testimony, which inserted all the tables that had been inadvertently left out of the initial draft of his testimony. So that was the motion, the notice to the the errata notice to the direct testimony of Roger A. Moran. NMGC number 4, ma'am.
Yes, sir. Dr. Moran, are you familiar with Gas Company Exhibit 4, which was the errata notice that inserts 4 missing graphs from your
Yes.
testimony?
Yes, ma'am, I am.
And that you prepared the graphs included in Gas Company Exhibit 4,
That is correct.
and they're true and correct?
Yes, they are.
And if you could do those graphs today, would they be the same as the ones that you prepared?
Yes, they would be.
Very well. Based upon Dr. Moran's verification of the information contained in exhibit number 4, and pursuant to the no objection agreement, and verifying that Gas Company Exhibit 4 is in fact in the Dropbox, I will remove the provisional ruling and admit Gas Company Exhibit number 4. Mr. Doman?
Thank you, ma'am. And with that, Madam Hearing Examiner, I would tender Dr. Moran for further examination.
Very well. Thank you. Dr. Moran, good morning.
Good morning to you, and I wish I was there in person.
I wish you were here in person too.
I am
Or
very-
I wish I was in Canada. I hear that's where you are right now.
Yeah, I am in the province of Nova Scotia, right on the ocean, 65 degrees, and very comfortable here.
Well,
I'm a
I'll tell
very
you,
frequent visitor to New Mexico, at least twice a year for artistic reasons.
oh, excellent.
And I love New Mexico.
We're glad to hear that. We encourage tourism and especially repeat tourism. And I believe the opera's getting ready to start. I thought I saw the notice. We get a fair amount of people for that, so might consider coming back for that. Dr. Moore, I think I pretty much understand your testimony. I have a couple of sort of general questions for you with regard to the first one is with regard to the ultimate stipulation. You're familiar with the stipulation, Dr. Moore?
Yes, I am.
And but you didn't file testimony in support of it, did you?
No, I did not.
And I note that in all of the different methodologies that you provide in your testimony, so for example, if we look at page 68 of your testimony at table 6, where you give your summary of the ROE estimates, none of the ROE estimates are as low as the agreed upon stipulation return on equity of 9.375, are they?
No, but let me make an important point. The direct testimony and the summary that you have in front of you was based on November 2021 data, and it was a bit stale. So in anticipation of prior to the settlement, in anticipation of the rebuttal phase, I did prepare an updated recommendation using fresh data. And I'll be glad to supply you with the same table that you have in front of you based on current data. And I was going to recommend a slight decrease in my recommended ROE down to 9.9. In the summary, the updated summary using fresh current data, there was indeed a number of 8.9, another one was 8.8, and so forth. And the average was 9.9% instead of 10.1. And therefore, I was going to decrease my recommended return from 10.1 to 9.9.
Okay, well, can we go through that, sir, if we're looking at your table 6, and can we go through
Yep.
how what vintage data did you use, and how did that affect the numbers in table 6?
Okay, let's take a look at table 6. And whereas let's go down the list of numbers, the 10.4 remains the same on the CAPM. The 10.6 remains the same on the empirical CAPM. The historical risk premium goes from 9.8 to 9.9, so it's pretty close. The allowed risk premium goes from 9.8 to 10.2. And the DCF numbers, the next 4 numbers, are the ones that are much lower. The DCF for electric utilities value line growth is 8.9. The DCF number for electric utilities based on analyst forecast is 8.8. And the DCF on natural gas utilities, there's a huge decrease there, down to 10.9. And the last number is now 9.2. And the average is 9.9. And if you focus just on the 4 DCF numbers, the average is 9.5%, just the DCF numbers, which by coincidence is exactly the same number that Mr. Staff Witness Tupler submitted, I think, in his document to you. And I do note that Mr. Tupler does a pretty good job of his ROE testimony and DCF analysis.
And
does that answer your question?
yeah, well, except the only thing that I don't know yet is what was the vintage of the data that you used?
May 15th. And I'll be glad to supply you with the exhibits and the underlying data if you so wish.
Yes, sir. I think we'll consider that bench request 8. Mr. Dome?
Yes, ma'am.
So the settled ROE number 9.375 was indeed in the range of my various estimates.
Well, how would you characterize it, Dr. Moore? I understand it's within the range, but I mean, do you think it is, a reasonable number that's going to achieve a positive financial impact for the company?
I believe there's several considerations then going to a settlement discussion. There's a lot of give and take on other parts of the case as well, and not just ROE. But I do consider the number to be a bit on the low side. The average authorized return in the US for gas utilities is about 9.5. So we're fairly close at 9.375. But it's a bit on the low side, also given the risks that I talk about at the end of the direct testimony relative to the peer group. So I considered a slightly underestimate.
Well, do you think it's going to have a negative impact for any of those persons that are looking to invest, that they would say, I mean, we always in these cases, we always hear a lot of testimony and speculation that, if the commission doesn't do X, then it's going to have a negative investor effect and potential downgrade by the rating agencies. And I'm just wondering if you think that there could be negative implications if the commission were to adopt this settlement, including the 9.375 ROE.
Well, my major concern is that this company has to raise approximately $750 million in the next 5 years. And that's a lot of money. And to put that number in perspective, that's compared to the equity base of the company, which is 500 million. So the company is going to actually increase its equity base by some 25%, which is horrendous. Now, half of this money has to come from bonds, from debt, which is about what, 375 million, and the other half has to come from equity. And the question is, will the internal cash flows be sufficient to accommodate this $375 million of equity that the company really needs? Probably not. So the company definitely will have to get some equity from the parent company. And the question that I'm concerned with is, will the 9.375 be sufficient to attract this kind of money when other gas utilities are being allowed somewhere in the 9.5, 9.6 range? I don't think I don't think the bonds will be downgraded or anything like that. And there are other components of the decision, of course, that the markets look at, not just the ROE number. So I wouldn't be too alarmed at the investor reaction or non-reaction, but it's low. It's a bit low. When people forget in this business that utilities are monopolies on the product side, on the services, on the gas side, but they're in perfect competition with everybody else on the input side, on the market for capital. So if you're competing with everybody else for capital, you have to offer the going rate. And that's my only concern here with the 9.375. But I would not be too alarmed at 0.1% lower than the average allowed return. Does that help?
It does. What I'm wondering is, that they stipulated their last gas rate case. Are you familiar with that?
Only generally, because I was not involved in that case.
Well, they stipulated the very same return on equity in the last case. The 9.375.
Yeah.
And I'm just wondering whether or not that has, you think that, continuing the same return on equity, in the last case, whether or not that has any effect, positive or negative.
Mhm. That question probably should be addressed to the company, but it's kind of strange that they would agree to the same number, given that we're facing a steady increase in interest rates, which started approximately a year ago. So and the ROE numbers are expected also to increase in the industry overall for the next couple of years because of high inflation, high interest rates, and so forth. So it's a little bit surprising, but I think that question is best asked to the company.
Yeah. One of the questions that I've been asking the company and it has to do with strategy, I think. And, obviously it's a company decision, but the company has filed 3 rate cases in 4 years. All 3 of them have been stipulated. And I'm wondering, I think I can't seem to find my chart right now, but if I recall, the total of the 3 cases, the increase in revenue requirement is approximately 26 million. Whereas I think the first one was like 2 or 2.5, and the next one was like around 4, and then this one is 19. And I'm just wondering from, again, a financial perspective, and I've asked their witnesses about, they keep stipulating these cases, whether or not you think that filing multiple rate cases in a short period of time has any positive or negative effect on how somebody a stockholder or a potential stockholder might value a company that engages in that activity.
It certainly raises a red flag. What you're talking about is pancaking rate cases, essentially. And that usually implies or suggests that the company is not earning its allowed rate of return, and therefore they have to file for a rate case. Now, what is the cause of that? Well, maybe the rate of return is too low. Maybe there was some cost as allowances. Maybe there were some lack of prudencies, or there's some reason why the company is not earning its allowed rate of return. And therefore, that leads to pancaking rate cases. And that's not viewed very positively by people that evaluate regulators like S&P Global Intelligence or Value Line or other services that evaluate regulatory risk. It's certainly not a positive thing to have a rate case every year.
I heard testimony yesterday that if in looking at the numbers since the last rate case with the 9.375 that they agreed to, that they actually earned more than that, their return. I mean, I'm looking at it just from, again, I don't understand if you come in, like in this case, and you want $40 million revenue increase, but you settle for less than half of that. And, you know, I understand negotiation and I understand give and take, but, you know, I mean, we're getting, you know, at least $1 million, if not more, in the first two rate cases, each of rate case expenses, and the rate case expenses in this case are almost $2 million. So it's like, I guess I'm sort of at a loss to understand if a company comes in and says we really need this revenue increase. What it seems to me it would be better off to go ahead and try to litigate that rather than and maybe you get what you need and you don't have to come back for 3 rate cases in 4 years.
I don't have any objection to your comment. I think it's a very good comment. And I think it's best answered by the company senior management. My job is to come up with a fair and reasonable rate of return that will attract the capital necessary and so forth. And beyond that, but I do sympathize with and understand your concern.
Well, as you've indicated, you know, it raises a red flag. It may not be because they're not earning their return. I don't know what it may mean. And I'm you're a very learned person in rate of return and the accompanying financial implications. And I'm just, you know, I thought perhaps that you might want to opine on this subject.
Well, I'm not a company officer, so but, I would probably, if I was, I'd probably go along your point of view.
All right, Dr. Moore, I appreciate that. And again, I think, you know, I think you've testified now that the agreed upon return on equity is, you know, is within the range of what you calculated. And even though it's on the low side, you think that if that's what the company chooses to do, then they can do that, right?
Correct.
And that there's a reasonable basis in your analysis for them to make that choice, right? Correct, sir?
Yes, correct.
Okay, very well.
The
Thank
way
you, sir.
I have to say that I did enjoy your questions that I had provided answers for. I think they were very probing and interesting questions. And I apologize for the length of my responses, but these were interesting issues to discuss.
And I give the credit to for those questions to hearing examiner Ryan and his thirst for knowledge. This is his first major rate case. And I have encouraged him to ask as many questions as he thinks appropriate. And I think you were the one of the witnesses that he had the most questions for. And so I'm going to turn it over to him for you all to discuss those questions and any others. So thank you, sir.
Thank you, madam.
Hearing examiner Ryan.
Yes, hello, Mr. or Dr. Morin. How are you?
I am fine. How are you?
Yes, and
I
I
understand that you're new in this business. One would never know it from the quality of your questions. But anyway, go ahead.
Well, what can I say? I keep going back to graduate school, so I feel like I'm just a professional student, frankly. That's sort of where I live in the world. But thank you. Now, I did want to appreciate your responses to the questions. They were thoughtful and, you note there that most of them are theoretical discussions, and I agree entirely. So thank you for taking the time to respond as you did.
Welcome.
Just at a macro level, I've obviously just listened to everything that you and Hearing Examiner Hurst just discussed, and I'm wondering some of the comments you were making regarding, companies generally in competition. I'm just trying to understand how, if New Mexico Gas Company is a subsidiary of the publicly traded company, how does that generally reflect, perhaps, or I say, what does that do to the discussion you just had with Ms. Hurst? And I realize I'm asking you something very broad there, but I guess I just want to know, when you're thinking about the analysis here, and it's really kind of a question about how does Emera attract capital? I mean, but maybe that's not correct to say. Can you clarify it all about?
Yes, New Mexico Gas obviously is an operating subsidiary of Emera, and Emera is the one entity that has to raise the capital. And again, Emera is competing with everybody else, including utilities, to attract capital. So they got to pay the going rate. And if one of the operating companies is not earning the cost of equity, Emera, the parent, will have a difficult time raising the capital. And it could be as bad as the stock price going down relative to other utilities if their subsidiaries are not earning the cost of capital. So it would be unfair, for a subsidiary to not to carry its fair share of the burden at the parent level.
Okay, so was it fair to say that as professional investors and institutional investors are thinking about where to park money, to the extent to which the larger parent company holds subsidiaries, I mean, they're scrutinizing the books of all the underlings, so to speak.
That's correct. And that, if you look at the 10K reports, for example, you see all the data on the operating utilities and their earnings and their profitability, their capital structure, and so on. So, yes.
Okay. So I understand your clarification earlier that you've reviewed fresh data and that's changed, and I heard all that. So the questions I'm going to ask you now were sort of predicated upon your responses in the direct testimony, and to the extent to which you say, well, having renewed my analysis, that's sort of my answer to this question. I'll understand if that's your answer to some of my questions. So, but I'll ask them nonetheless. So at page 10 of your direct testimony, you wrote that ultimately, to ensure that New Mexico Gas Company has access to capital markets on reasonable terms for its capital needs, a fair and reasonable authorized return on equity of 10.1 is required. And so the question I'd ask is very simply, will New Mexico Gas Company have access to capital markets at 9.375? And you've answered that when speaking with Ms. Hurst, but if you have any further comments, give you the opportunity to do so.
It's on the low side. It's going to be difficult, but I suspect that investors look at many other variables, not only just the allowed rate of return, before they make investment decisions. They look at regulatory policies. For example, does the company have a future test year? Do they have risk mitigating mechanisms like revenue decoupling, or are they getting supportive rates of returns? Are they getting their costs basically reimbursed and so forth? So investors look at a whole bunch of things, not just the ROE. But I do feel that the 937 is on the low side of things. But I wouldn't be too alarmed as to whether the company will be completely shut off from capital markets. I don't think we're there yet.
Okay. And is that number going to be sufficient to maintain New Mexico Gas Company's credit worthiness?
Marginally. It's not a positive thing for the bond rating agencies when, the averages in the industry, both electric and gas, is around 9.5, 9.6, and we're at roughly 9.4. But it's, again, I wouldn't be too alarmed at a 0.1% differential.
Okay. In your direct testimony at page 35, you provided, this was your initial estimates under the varying DCF estimates. And at a very basic level, I was wondering, that type of spread all the way from 8.6 to 11.4, is that fairly typical? I mean, do you see that kind of a level of divergence in terms of how you plug the numbers, I suppose, for lack of a better word?
Good question. The culprit here for the wide divergence in the data is when you're using a very small group of peer companies, you tend to have this sort of all over the place numbers. And that's why I'm very, very fond of using very large peer groups. As I did in this testimony, I look at combination gas and electric utilities. And if you look at the spread in DCF numbers for that group, it's not nearly as volatile. It's much more centered around a given number. So we're using a very small peer group, like 5 or 6 companies, measurement error, statistical reliability sort of becomes an issue.
Okay.
I vaguely remembered that in the gas group, peer group, one of the companies had an expected growth rate of something like 11.5%, and obviously biased the results upwards. And that's the kind of thing that can happen if you have a small peer group. And that's also why you want to look at other methodologies.
That's why you
want to examine other methodologies.
thank you, sir.
I'm sorry.
Dr. Warren, isn't it possible just to, when you're doing that analysis, if there's an outlier that you know for a specific reason isn't applicable and it's going to skew the results, can't you just leave that company out with explanation?
You can if it's completely outlying variables, but then where do you draw the line? You also eliminate the low numbers as well as the high numbers. So I prefer to use a central tendency. Then I take comfort in the fact that I use, several methodologies to confirm the results from DCF. That's one of the messages that I have to give you, that one of the reasons for using multiple methodologies is to corroborate the results of the DCF or any other approach for that matter.
But shouldn't the companies that you're comparing to gas company, shouldn't they have some kind of similar characteristic to give comfort that you're not comparing an apple to an orange?
Well, the peer group for natural gas utilities is very, very small. Mr. Tupler, I think, and the staff witness has 5 companies. I have maybe 7 or 8. And we're losing companies year in and year out because they're getting purchased by larger electric utilities like Southern Company buying Atlanta Gas Light and so forth. And so the sample size is getting smaller and smaller. And that's why I use 2 peer groups, including combination gas and electric utilities. And there's not so much noise because I have a very large sample here, a la FERC.
Thank you, sir. Thank you, Hearing Examiner Ryan.
No, it's fine. I'm glad you interjected. I mean, I have other questions about what is the end result of that consolidation in terms of, I mean, can you speak to that question? When you said it's problematic for comparison purposes that these things are all being bought up, but if consolidation is the path forward, I mean, what does that mean in the long run?
Could you sort of help me out with your question here?
No, I don't know that I have a specific question in mind. I was listening to what you said to Ms. Hurst. You said that it's challenging to do the comparisons because there's so few gas companies and they're all being purchased by larger entities. And so if that trend continues and the challenges remain, I mean, how do if it gets worse, what do you do?
Yeah. Well, down the road, if I'm still around to testify in the next several years, we're going to be looking at a consolidated energy group as opposed to just electric or gas. They're going to be hard to distinguish one from the other. And I'll make sure I shouldn't raise this point here, but one can look at the possible down the road reduction or disappearance of the natural gas rate base due to the growing electrification in the country at the expense of gas. The decasification will go along. because of all this renewable stuff and the consumers have alternative choices for energy, one certainly wonders about the future of natural gas. But presumably this is priced in the stock price and in the bond ratings and so forth. So I didn't dwell on it too much in my testimony, but that's certainly a concern.
And I guess that's, I mean, I noted that response in your bench request responses, and I guess I would ask you is that, do you feel that's like a true statement that that information is priced in already, that the uncertain future? I mean, I know with certain places in California and these so-called progressive cities have all outlawed gas and new development, that is reflected in the market already?
Not fully. I think it's slowly coming eastward from California, which has a very, very difficult 100% renewable target in 2030, I think it is. And a lot of that will be at the expense of Southern California Gas Company. And this will slowly, I guess, permeate eastward. But we're not quite there yet. I don't think investors fully realize the implication of electrification of society at the expense of gas.
Well, for purposes of this rate case, it would seem that, I mean, you can correct me if I'm mistaken, but that would be a basis, that risk would be a basis for a much higher return on equity. Would that be a correct statement?
That would be a correct statement, but I'm hoping that the stock price of the natural gas companies do contain some reflection of this possibility.
Okay.
But right now, fortunately, right now, there's a sort of a counter current because of all the goings on in the world today and the higher inflation rate and higher climbing interest rates and Ukraine and so forth, especially inflation. Investors tend to gravitate towards safer havens, and they're gravitating towards utility stocks. That means higher natural gas stock prices, which obviously lowers the DCF estimates.
Yeah.
Which is exactly what's happened.
Okay. And I suppose one could say as well, like perhaps the macro picture and the appetite of the consumer to pay more for energy prices is perhaps buoying some of that too. I mean, I guess you could wonder in 20 years, whatever. That's a broad question. I know, an interesting one, but so on page 69, you indicate that, again, this is based on your initial testimony, that a 10.1 is really effectively the bare bones and conservative. I know you've, basically revised it on new data. And I've heard you say several times now that 9.375% is low. I suppose at the end of the day, what I'd ask is the 9.375 just and reasonable? And I guess, and just ask you to respond to that last question.
Yeah, if I was testifying today, and my recommendation would have decreased from 10.1 to 9.9. Now the settled, I would characterize the 9.375 as bare bones, as on the low side.
Okay, thank you very much, Dr. Morin, for your time, and appreciate your testimony. And I'm guessing at some point I'll probably read your book. So,
yeah, the latest edition just came out about a month ago. So
very good.
I'll be glad to send you a complimentary copy.
Oh, well, thank you very much.
Okay, I'll do that.
I would appreciate that. Thank you.
I will definitely do that.
Good.
And it's not all pro company or pro regulator. It's pretty fair.
Very good. Thank you very much for that.
Yeah, okay.
Ms. Hurst.
Hearing examiner Ryan, no questions of your bench request
No,
to Dr. Moore?
no.
Okay, very well. Mr. Dome, any redirect for Dr. Moore based on my questions or hearing examiner Ryan's questions?
Just a couple, Madam Hearing Examiner.
Go
Dr.
ahead.
Morin, I think your testimony is that the 9.375 is within the range of reasonableness, but on the low side. Is that correct?
Yes.
And that the national average is more in the range of 9.5, something like that, correct?
9596.
9.596 is one of the, and then I think you testified that the decision on there's a lot of factors that go into a settlement. ROE is just one of them, but there are a lot of factors, correct?
Yes, sir.
Is one of the things that could influence a company's decision to settle that a jurisdiction that company operates in has a history of awarding relatively lower ROEs to utilities compared to the national average?
It could be, but I really don't want to go there.
Well, but it's one of the factors that they could take into account, correct?
It could be, yes.
Sure. And is one of the things that might be taken into account is if a jurisdiction relies upon the DCF model as opposed to more of a balanced view of setting ROEs. That would be a factor as well, correct, sir?
Yes, definitely would.
Thank you,
Yeah,
Dr. Moore.
when
That's
you're
that's all
trying
I
to
have.
measure, oh, sorry.
all I have, Dr. Moore. Thank you very much.
Does anyone have any questions for Dr. Moran based upon hearing examiner Ryan's questions or my questions?
Madam Hearing Examiner, this is
Mi-
Peter Gould. Not
Mr.
really a
Gould?
question, not really a question, but point of personal privilege. Welcome back to New Mexico, Dr. Moore. I just wanted to say that when I was first doing this, was working for the AG's office and made the mistake of trying to cross-examine you on utility ROE in the P&M rate case in 1992.
Oh, my
And
goodness.
you gave me a mini graduate course in how ROE is established. And it's nice to see that we're both still doing this 30 years later. So I'm actually pleased. That's one of the reasons why we settled, so I wouldn't have to cross-examine you.
That happens to me very frequently.
But thank you,
Um,
Dr. Moore.
yeah.
Appreciate it.
And
Appreciate
again,
your very balanced analysis of where we ended up with the stipulation. Thank you.
Look forward to seeing you again or not seeing you again. But
Okay.
I do look forward to my next visit there.
Okay, thank you.
Thank you, Mr. Gould. Any questions for Dr. Moran? Hearing none. Dr. Moran, thank you very much, sir, for your time. We appreciate it and your excuse, sir.
Thank you.
And that is subject to answering the bench request.
Yes, ma'am.
For providing-
We'll get
okay.
that material to you.
You know, and let me just, maybe now's an appropriate time for me to say, and the parties can think about this, and then, when we're wrapping up at the end, if someone's going to have a different position. But, pursuant to 1.2.2.35K, which is the section that I utilize for bench requests. It's actually entitled Additional Evidence. At any stage of the proceeding, the commissioner or presiding officer may require the production of further evidence upon any issue. Such evidence may, at the discretion of the commission or presiding officer, be in writing or presented orally. All parties and staff will be given the opportunity to reply to such evidence submitted and cross-examine the witness under oath. Previously, in this case, the parties have agreed to not ask questions or not object to not only the witnesses offered in this case, but also the introduction of any bench request in this case. It is my thought that of the bench request issued in this case, the parties will all be waiving that opportunity to respond and cross-examine the witness who offers that particular response. That's what I'm anticipating. Parties can be thinking about that. And I think perhaps at this juncture, I have 10:15. I think we'll take a 10-minute recess. We'll come back. And I believe at that point, gas company will have witness Buchanan.
Yes, ma'am, that's correct.
Very well. Let's take a 10-minute recess.
And Mr. Dome, I admitted Mr. Buchanan just so you can verify with his audio and stuff.
Okay,
wanna-
thank you.
Yep.
Thank you. Hey, Eric, can you hear us? Oh, okay, he's still connected. Eric, can you hear me?
Unmute.
Eric, can you hear me?
I hear you. Hello.
Okay, good.
You look good, and I can hear you. Say something, Eric. Say something intelligent.
Hello, good morning.
That's excellent.
We're on
Okay,
a 10-minute break, Eric, so we're
Yeah.
gonna come back in 10 minutes.
10-minute break, but you're all set up.
Okay, sounds good.
All right,
If you
thanks.
stay on, you can mute
Okay,
yourself
all
and
right.
take your
Okay. I believe we are, Mr. Lee, are we ready?
Yes, ma'am.
All right, sir. We're back from our recess and Mr. Haverly, gas company has another witness.
Yes, ma'am. New Mexico Gas
Go ahead,
Company. New Mexico Gas Company would call Eric Buchanan.
Mr. Lee, would you please swear in Mr. Buchanan?
Sir, would you please raise your right hand? You solemnly swear the testimony you're about to give in the matter not pending should be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you.
Mr. Buchanan, would you please state your name, your full name for the record?
My name is Eric, E-R-I-K, Buchanan, B-U-C-H-A-N-A-N.
Mr. Buchanan, who are you employed by and what is your position?
I'm employed by New Mexico Gas Company, and I'm the Director of Forecasting and Planning.
Mr. Buchanan, you have in front of you what has been marked New Mexico Gas Company Exhibit number 29. Do you recognize this?
I do. That's my direct testimony in the case.
Was this testimony prepared by you and at your direction?
Yes, it was.
Do you have any changes or corrections to NMGC Exhibit number 29?
I do not.
If I asked you the same questions that are contained in Exhibit number 29, would you provide me with the same answers today?
I would.
And would those answers be true and correct to the best of your belief and knowledge?
They would.
Mr. Buchanan, you also have in front of you what has been marked as NMGC Exhibit number 30. You recognize it?
I do. That's my testimony in response to the May 19th order requiring New Mexico Gas Company to submit evidence.
And was that testimony prepared by you and at your direction?
It was.
Are there any changes or corrections you have to this testimony?
No,
If I asked you the same questions contained in that testimony, would you provide me with the same answers today?
I would.
And those answers would be true and correct to the best of your knowledge and belief?
They would.
Mr. Buchanan, I'd like you to look at New Mexico Gas Company Exhibit 31, which you have in front of you. Do you recognize this?
I do. That's my direct testimony in support of the stipulation.
Was this testimony prepared by you and at your direction?
It was.
Are there any changes or corrections that you have to this testimony?
No.
If I asked you the same questions contained in this testimony, would you provide me with the same answers today?
I would.
And are those answers true and correct to the best of your knowledge and belief?
Yes.
And Mr. Buchanan, finally, you have what has been marked as New Mexico Gas Company Exhibit number 32 in front of you. Do you recognize it?
I do. That's my
What is-
testimony in response to the hearing examiner's June 6th bench request.
And was this testimony prepared by you and at your direction?
It was.
Are there any changes or corrections that you have to this testimony?
No.
If I asked you the same questions as contained in this testimony, would you provide me with the same answers today?
I would.
And are those answers true and correct to the best of your knowledge and belief?
Yes.
Madam Hearing Examiner, I will represent to you and to Hearing Examiner Ryan that New Mexico Gas Company exhibits number 29, 30, 31, and 32 have all been uploaded to the Dropbox pursuant to the Hearing Examiner's orders. And with that, I would tender and request for the admission of New Mexico Gas Company's exhibits number 29, number 30, number 31, and number 32.
Very well, Mr. Howley. New Mexico Gas Company Exhibit number 29, Mr. Buchanan's direct testimony and exhibits in support of the application as verified by him here today and pursuant to the non-objection agreement of the parties and the verification from Gas Company Counsel that the correct copy of Gas Company Exhibit 29 was put into the Dropbox will be admitted. Gas Company Exhibit number 30, Mr. Buchanan's supplemental testimony in response to the order requiring Gas Company to submit evidence as verified by Mr. Buchanan here today and as indicated by counsel for Gas Company that the true and correct copy of Exhibit 30 has been placed into Dropbox will be admitted. New Mexico Gas Company Exhibit 31, Mr. Buchanan's direct testimony and exhibits in support of the stipulation as verified by him here today, subject to the no objection agreement and pursuant to New Mexico Gas Company's counsel's verification that the correct copy of Exhibit 31 has been placed into Dropbox will be admitted. Gas Company Exhibit 32. Mr. Buchanan's testimony in response to the hearing examiner's bench request is verified by him here today, subject to the no objection agreement of the parties and pursuant to Gas Company Counsel's verification that the conforming copy of Exhibit 32 is in the Dropbox will be admitted. Mr. Haverly.
With that, Madam Hearing Examiner, I tender the witness for further examination.
Very well. Good morning, Mr. Buchanan.
Good morning, Madam Hearing Examiner.
How are you?
I'm doing well. How are you?
Good. I'm okay.
Good.
My understanding of your direct testimony, Mr. Buchanan, is that you testified on page 4 that Gas Company developed a fully functional Excel-based cost model to support its rate filing. Is that correct?
Yes, ma'am, that's correct.
And Gas Company utilized this model previously in its last prior rate case, case number 19-00 317. Is that correct?
Yes, that's correct.
And was it developed or utilized prior to that time?
I believe the 2019 rate case, which is the 317 rate case you're referring to, was the first case where it was used by New Mexico Gas Company.
Is it unique to New Mexico Gas Company?
Obviously the information contained in the model is unique to New Mexico Gas, but I think the fundamentals of how the model works are not, and were developed based on other future test year filings by other utilities in the state.
Well, I know you testify on page 2 of your testimony at line 19 that the model was developed by Concentric Energy Advisors Incorporated, correct?
That's correct.
So, I mean, did you buy the product from them in the last case and just get to continue using it? Or did you have to re-employ them?
No, I think you categorized it correctly. It was built as a part of the last case and accepted in that filing. So we thought it was a good basis to continue using it for this filing.
Okay. Did it have to be updated or?
For the most part, the model remained about the same as it was before. Obviously, we updated it with new information and assumptions. And I think in some minor cases, we may have made it a little bit more functional. For example, in the prior model, the disallowance of the equity return on the Williams assets was not fully functional.
I'm sorry, equity return, I didn't quite catch that. Equity return on the,
I apologize. The disallowance of the equity return on the Williams assets,
radiance?
Williams assets,
Thank you.
was not fully functional, and in this case, it was.
I have a clarification question, Mr. Buchanan, with regard to your testimony on page 6 and the second linkage period. Your testimony on page 6, you're answering the question posed at line 5 through 7. What time periods did gas company use to develop the revenue requirements supporting the company's rate request? And you talk about the base period being the 12 months ending June 30th, 2021. The adjusted base period utilizing the same 12-month period. The future test year period consisting of a 12-month period ending December 31st, 2023. And then at line 13, you begin talking about the linkage period data with linkage period 1 providing data for 12 months ending June 30th, 2022. And you say linkage period 2 for the 12 months ending December 31st, 2022. Is that correct?
That is correct, and I can elaborate on that if you like, or I can just confirm.
No, and you can do both. My question was that supposed to be 2023 or 2022? And your answer is 2022.
The end of linkage period 2 is December 2022.
Okay. And I note on page 7 of your testimony at lines 12 through 14, you've testified the linkage periods provide data to better understand the change in rate base and operations from the base period to the future test period, correct?
Correct.
I've heard some testimony previously this week that I believe notes that there are some difficulties with using a future test year period in that projections differentiating projections into the future for a number perhaps are not quite as accurate as historical numbers in, for example, a historical rate case. Do you agree with that?
I agree that the use of strictly a historical test period, would be based on actual information, and that in a future test year, you're forecasting information. That said, we go through great care putting together our cost of service model. Fundamentally, we start with actuals. Those actuals are audited under the requirements of an NPRC rules. They're audited by an external auditing firm. Then we make adjustments to those actuals to basically conform the base period or to normalize the base period to remove certain kinds of transactions that we don't think represent operations. And then in the case of our model, we tend to use broad escalators based on published or verifiable information, like our inflation escalators or our labor escalators.
Or our neighbor escalators?
Yeah, labor escalators. Except in cases where we think we have more accurate information, then essentially what we would do is remove those escalated costs and replace them with something that we think is a more accurate forecast. Which is all to say, we do our best to produce an accurate future test year model.
From your perspective in your assignment with the case to come up with what you believe is an accurate representation of what the company cost and revenue requirement is, how do you see your work product in light of what gets stipulated?
I think that the information that we put together in, I'll call it the as filed rate case in our original application, reflects a sound basis of what we're hoping for in the case. I don't think necessarily in either a settled case or a litigated case, the outcome is going to be exactly what we file for. And so I don't think a settlement erodes the work that we did in putting together our original application. Does that answer your question?
Well, and your answer is your answer, sir, and I appreciate that. I guess I'm just looking at it in context. And have you been listening to the other witnesses this week?
I have. I missed a little bit of Mr. Racine and then a little bit of Dr. Moore, but otherwise I've been pretty attentive.
Well, and one of my concerns, I think, throughout has been that if one takes the case as filed and the testimonies in support of the case as filed, there's some pretty persuasive testimony in there about we need this employee, or we need this IMP project. And then you get to the stipulation and it's like, oh, well, we've changed our focus now and we're not going to hire these 32 people. We're gonna try to retain the people we have. And obviously, I understand that testimony also. But when you, when you're on the outside looking in, and as I have commented to hearing examiner Ryan, I've always found stipulations to be a lot more difficult than litigated cases, because all the people in the stipulation know more about what they agreed to and they gave up than people who weren't part of it. And I guess I'm just trying to put in context. I mean, you're the director of forecasting and planning. You know, you brought this model in. You're telling me these numbers are accurate, and that they support what the company filed. And that's not ultimately what the company settled for. So I'm just trying to, understand the company's justification in light of all this hard work that it put in and these costs for these models, but yet they're willing to take less than half.
So I'm sorry, there's sort of a lot of information in there. Can you clarify the question?
Yeah, well, the bottom line is, if New Mexico company believed in the case that it filed, why did it settle for less than half?
Well, I think the settlement in this case was based upon a lot of discovery. My understanding is that we had more discovery in this case than we had ever had in the past, and that that discovery represents a very thorough review of the information that we submitted in our original filing. That work is being done by people who are experts in their field. Certainly you've heard from some of the non-gas company witnesses now, and I assume you'll hear from more of them, but they're all experts in their area. And that the settlement results in an agreement between all of those parties to provide a fair and reasonable outcome in the case. So I think that it is accomplishing what the objective of a litigated case would be, which would also be, fair and reasonable outcome to the case.
So I'd like to have you talk a little bit about escalators. And if
Sure.
we look at your testimony on page 34, and in your table 2 entitled escalators, you have the various escalators that gas company chose to utilize in the different time periods for different types of O&M expenses, correct?
That's correct.
And I know you testify on page 35 what you're seeing in the rest of the nation. And then you also testify that you have used annual forecasts regarding inflation to determine the appropriate escalator, correct?
That's all correct, yes.
Is there anything else that you use other than projected inflation?
No, I think our preference was to rely on, published information from industry experts So when we use the U.S. Energy Information Administration or the Federal Open Market Committee meeting minutes, those are all that's all publicly published information produced by experts in their area, and so we relied upon that for our escalations for non-labor.
Our escalations for non-labor,
Yes, sir.
Well, and I'm just wondering how or if these escalators that you use relates to the merit labor increase situation that occurred with gas company.
So
Is there any correlation between the two?
For purposes of the cost of service model, the mathematical calculations of the model, there is no correlation. Certainly, I think that we are seeing today, rising labor costs and a more challenging labor market. And I'm not an economist, but I think it's fair to say that that also is being the result of some of the inflationary pressures that we're seeing.
Well, I guess, and I understand that, sir, from the modeling perspective, but I'm just wondering if maybe, if it's appropriate or not to have some more inputs to your consideration of those models. I mean, something other than inflation, when you look at, vacancy rates, or, the situation with the lab poaching employees, and this, potentially emergent critical situation of losing 5 employees in one day and in a particular region. And, I'm just wondering if more input, more labor input on the front end of this cost model potentially could have alleviated the situation.
Yeah, that's an interesting perspective. When I think about that, I walk back to my experience in putting together the case. And, so we were in 2021. It was still, certainly we were in the COVID period. People were starting to get vaccinated. It really felt like we were going to emerge from that situation quickly. And of course, nobody could have predicted what has happened now. But I think the expectation then was that, we were going to very quickly return to more of a normal situation. A part of what we did was we increased labor by the 5% escalator. Ms. Wilcox talked about that earlier. So we did embed some incremental raises based on information that we had at the time. And then as time moved on, we started having the supply chain issues and the labor market challenges that we're seeing today. And we have been working very hard to respond to those in the model. So I guess the short answer is I think when we filed the case, it would have been very challenging to anticipate what we're seeing in the labor markets right now.
And understand, Mr. Buchanan, I'm not being critical of the company and its planning process. I'm just trying to find out from you whether or not there are other things that the company could consider other than some number from some entity in its assumptions and what it builds into its cost modeling.
Maybe the next thing we might have relied upon would have been, what we were seeing in historical CPI, and CPI is Consumer Price Index. And at the time, the Consumer Price Index was high, but I don't think anyone at the time was expecting the supply chain issues that we've experienced, recently. And so most of the forecasts at the time had pretty conservative future inflationary rates.
Okay. Oh, I have another question, sir, with regard to page 48 of your testimony. The question posed at lines 18 and 19, did gas company exclude the expenses for its long-term incentive compensation program and a 401k performance match? And you answered in the affirmative. Why did you make that adjustment?
I think Ms. Wilcox talked about this a bit earlier, but the 401k performance match is something that only funds if our incentive plans achieve, I think it might be maximum, but it's something higher than target.
Maximum, but it's something higher
Than target. And so what we include in our filing only assumes that we achieve our target metrics. And as a result, since that 401k is above target, we take it out. In terms of the long-term incentive compensation, I'm not sure specifically why it's removed. We've removed it in prior cases, and I think it's common for companies to take those programs out of their case. So when I saw that it was removed, I thought it was reasonable.
Is it done to pursuant to some accounting rule?
No, we could certainly seek recovery of those costs, and we do incur those costs. We just don't ask for a recovery of them in our rates.
And I did have a prior discussion, but I'm not sure. I think the question may have been answered, but I'll go ahead and ask you. On page 53 of your testimony, you're answering the question posed at lines 1 and 2. Has gas company made changes that resulted in a decrease of certain O&M expenses since the 2019 rate case? You answer in the affirmative, and you did a study for these A&G expenses. And the study determined that 10.4 million of the A&G expenses to capital projects should allocate 10.4 million of A&G expenses to capital projects rather than expenses. That's your testimony?
Yes, ma'am, that's right.
And remind me again what the A&G expenses are.
A&G costs are, for purposes of regulation, are they're essentially defined by FERC, and they're shown in our annual filings in our FERC Form 2, but they reflect all of the administrative and general costs of the company. So as an example, me as an employee in the finance department, I charge my time mostly to A&G.
And I don't recall what was the reason that they got switched from an expense, an O&M expense, to a capital project expense?
Sure, it's a practice that's very common in the utility industry, and part of it is just practical expediency. For example, I have conversations about particular capital projects or capital projects broadly on a day-to-day basis. And when I'm entering my time, I don't want to have to charge time to those individual projects every time I have a conversation about them. So, and other people experience that too, or we have, financial systems that maybe incur, that have service costs that are charged to A&G that ultimately support capital. And so a practical way to deal with that is to conduct one of these studies where you determine the amount of your A&G costs that are really in support of your capital program. That way, you can charge the costs to A&G, and then you rely on the study to reclassify those costs and recognize that they're really in support of capital. So it just reduces a lot of, burden, clerical, administrative burden doing it this way.
Well, do you already have to keep like a timesheet?
Of course.
What increments do you allocate in?
Well, I think I charge by the hour, but I don't get paid by the hour. It was
No,
a
I
joke.
just meant, yeah, no.
Not a funny one, I guess. Sorry.
Me either. Or by the word. Some people think that, lawyers get paid by the word. I'm not one of them that does. No, I just wondered, whether or not, for example, you keep some kind of tally sheet that says, okay, I talked about capital projects for 45 minutes today. Or something like that, or you just use a percentage allocation.
I don't personally do it that way, no. And again, I think, the purpose of the study is to look broadly at our A&G costs and determine those, the amount that are incurred in support of capital. And I think there was a second part to your question there, about why did we update it? And that's, not accounting rules would say that the study should be updated periodically, and it had been a while since it was updated. And also it's good practice to update those studies periodically.
Okay. Sir, if we can look at page 62 of your testimony, you're answering the question posed at line 11. What's the basis for gas company using a 2-year amortization period for the IMP regulatory asset? And you refer to witness blotter, and you say gas company believes that that time period balances the timely recovery of the cost and impacts to its customers. That's your testimony?
Yes, ma'am.
Do you believe if the mechanism had been, the IMP mechanism had been adopted, that it would eliminate the need for the regulatory asset?
Yes, if we were to get the IMP rider, then we would not need or have sought the regulatory asset.
I'm sorry,
Do you,
you folks are breaking up, then we would, not need,
The IMP regulatory asset.
thank you.
do you think that having the 2-year amortization of the asset encourages filing frequent rate cases for every 2 years without the mechanism, so that gas company can get the recovery?
I think the 2-year period is reasonable when you look at the alternatives. We could have sought, for example, a 1-year recovery period, in which case we would have continued to include in rates in 2024 an asset that we were no longer amortizing. That would be, one example. Or we could have chosen a longer recovery period, which would have reduced the customer bill impact further. but it may have resulted in us continuing to have an unamortized asset in our next rate case. And so we were seeking to balance out those extremes.
Let's look at page 64 of your testimony, Mr. Buchanan. At line 5, the question posed is gas company seeking to include any amounts in its rate base associated with pension assets and liabilities. Your answer is no. Is that correct, sir?
Yes, ma'am.
Why not?
For a large part, the assets and liabilities in pension are based on discounted cash flows. And so they don't necessarily reflect cash in or out to the company. And so we remove them from rates. We do include the expense of the plan in our rates. We just don't include, the basically assets and liabilities that are heavily dependent upon actuarial studies and net present value of cash flows and those sorts of things in our rate base.
Is that typical?
I do think it's typical. Some companies, I think, seek, trying to think what they call it. Sometimes they call it like a pension tracker, where they, if they've done accelerated funding of their plan, then they ask for a sort of a net asset in rates.
But when I say it's called something else than a regulatory asset, but
I'm sorry, what's the question?
no, I'm trying to think. It seems as if I've seen the pension asset be called something else, and I can't remember. So
Yeah, pension is a very fun accounting topic.
what, just so I understand within the company structure, Mr. Buchanan, you're the director of forecasting and planning, and Ms. Blotter is the vice president of finance. How do the two positions interact, and if so, how?
Yes, Ms. Blotter is my boss.
Okay. And the reason I ask that is because I'm looking now at your stipulation testimony, and I'm looking at page 5, and where you're talking about increasing the merit from the 5 to 9%. And I asked about that yesterday, so I have my answer about the pool of who that applied to. So the stipulation adjustments, as you testified to on page 6, in order to, you say at lines 3 and 4, in addition to the adjustments discussed above, the company made the following 7 adjustments to arrive at the stipulation cost of service. And in essence, the first bullet point at line 5, adjusted rate base by first setting net plan in rate base amounts to the actuals existing as of December 31st, 2021, and then decreased the proposed additions to plant and rate base in 2022 and 2023. And then at line 10, you say this reduced the company's future test year revenue requirement by 11,587,312. That's your testimony, sir?
Yes, ma'am.
So did you make that adjustment? Or was that adjustment made by someone else or in conjunction with someone else?
I think probably the latter of your comments there. I made that adjustment in conjunction with the engineering group, and specifically Tom Bullard. After he had reviewed and his team had reviewed plant and service at 12/31/21, and then also forecasted additions through the end of the future test year. They provided changes in their capital forecast to me to update in the model. And so my role in it was really, receiving inputs from Tom's group, Mr. Bullard's group, and then updating the model to reflect that new activity.
And was your understanding that the adjustments were accomplished by either eliminating or reducing certain plant?
Yes, it was accomplished by deferring, I would say, not eliminating, deferring certain projects.
Deferring. And the bullet point at line 15, that's 787,981. That's vacancy savings.
Yes, that's correct. In our original application, we had thought that vacancies would return to sort of pre-pandemic levels, and so we included a base period adjustment for those costs. And then in the case of the settlement, we removed that adjustment.
I'm
After
sorry,
hearing,
in the case of settlement,
In the settlement, we removed that adjustment.
thank you.
we removed that adjustment. So does, I thought I understood it until that last sentence.
Yeah.
So you increased the vacancy savings, which resulted in a bigger adjustment to the cost of service.
Correct. A lower revenue requirement, right?
Okay.
Yep.
Okay, so I did understand. Whew. Hearing yesterday that the vacancy savings is almost double what you projected, aren't you potentially going to have double that number?
I think that obviously our vacancies are higher than 52 right now. But I do think that in the case of reality and operations of the business, what's happening now is the vacancies have become so high that employees are incurring a lot of overtime. And so we're sort of at a wash position where we've got higher vacancies, but we also have higher overtime costs. And I think Mr. Sanchez discussed that when he testified.
Sir, I'd like a little clarification of your testimony on page 10. In support of the stipulation, the question posed at line 19 through 20. Do the accounting positions impact the agreed to increase in the base revenues of 19.3 million? And you say no. The accounting positions similar to the other individual cost of service assumptions, going on to page 11, have no impact on the agreed upon increase in base revenues. The determination of the 19.3 million was based on an arm's length negotiation rather than an assessment of the individual components of the cost of service calculation. Correct?
Yes, ma'am, that's correct.
What's that mean?
Well, in our original application, for example, we had proposed amortization periods for certain items. And in the settlement, we did not make changes to those proposals. However, those items aren't necessarily always specifically discussed in the stipulation. So I could see a scenario where someone would have naughty behavior and they might amortize things over a longer period to help with the stipulation. We have not done that. So basically what we're doing is we're affirming that it's our intent to amortize things the way we said we would and over the time that we would. And that also helps out our external auditors who need to know the amortization period for those assets and liabilities in order for them to give us an audit opinion, which we need for various reasons in our business. Did that help?
Well, it does in a way. It gives clarification on what the parties agreed to. I don't know if it necessarily.
Yeah. I'm sorry. Let me clarify. So the amortization periods and amounts for certain items in the case were not specifically cited in the stipulation, but it is our intent to amortize them the way that we represented in our direct testimony. And so that is all that I'm doing, clarifying. That's all that I'm clarifying.
Right, and I think I'm further aware of language in the stipulation that says, and
Right.
just because we're not commenting on this doesn't mean we can't challenge it in the future or something to that effect.
We have very similar language in the stipulation, yes.
And I may regret this, but I'm going to go ahead.
Okay, I may regret it too, it sounds like.
Let's talk about ADIT.
Okay.
On page 12 of your testimony, you are posing the question at line 14, please describe the company's amortization of ADIT. And you're discussing witness Avalon's testimony to amortize ADIT over 33 years. And you testify this amount is actually a cost to ratepayers, so the company believes a 33-year amortization is in the best interest of customers, correct?
Correct.
And that's because it gives them longer to pay it?
So I do regret your question, to be clear, because I'm not the tax expert, but I will do my best and hopefully save folks time. In our case, we have what's called the excess deferred tax liability that is related to tax reform in 2018. that we are refunding to customers. There are IRS rules that require us to refund those in a very specific manner, and that manner results in 33 years.
Results in,
33 years.
And
There's-
that's sort of what my question, are you finished, sir?
Yep, if you're happy, I'm happy.
Well, ADIT is always scary.
Judge, are you saying A as an apple, DIT?
Yes, sir. Can you define, sir, for the record, what ADIT is?
Accumulated, deferred income taxes.
Okay. And ultimately, my question was, that just really seems like a long period of time and potentially violative of the matching principles. That, you know, that the costs and benefits ought to be associated with the customer group that benefits with those.
Yeah, that's interesting. I guess I feel 100% the opposite. I'm sorry. I think it is, you know, that balance is the result of book and tax differences related to plant. Plant is
Points?
related to plant, primarily plant. And we're a utility, we have very long-lived assets. And so it should reverse over the remaining life of plant. And that's what the 33 years is meant to represent. I believe. Again, I'm not, I know I'm dangerous with taxes.
So you don't believe in the matching principle?
Oh, no, I think it is. I think it's exactly the matching principle. We're matching the amortization of balance with the remaining life of the plant that created that balance.
Okay. Well, that's as far as I'm willing to go into ADIT. How about you, Mr. Buchanan?
Me too. Thank you.
I do have a question on your exhibit 1, page 2 of 27. And that is entitled Depreciation Rate Study, Depreciation Rates Existing and Proposed Base Period and Future Test Year, and it's got the timeframes.
Yes, ma'am.
Where did the depreciation rate study come from?
This harkens to the A&G study similarly, but we perform periodically a study to determine our depreciation rates. In this rate case, the rates are exactly the same as what was filed for in the 2019 rate case, and that we have been using since that time.
So when you say we, gas company did its own depreciation study, or it contracted that out?
I believe we do contract it out.
And was that depreciation rate study actually approved by the commission in 19-00317?
I'm sorry, I had an internet glitch. Can you
I
repeat?
can. Was that depreciation study that you say was the same as used in the last rate case actually approved by the commission in that case?
I do not believe that it was approved by the commission in that case. But I don't, you're venturing into territory I'm probably not the best at answering. So I'm really not sure.
Not sure?
I'm not sure. That's my answer. Yes.
Okay.
Yep.
Mr. Haverly? Consider it a bench request. I want to know the particulars on the depreciation rate study, and if whether or not it was approved by the commission in 19-00317. If it was not, I want to know when those rates have been approved.
Yes, ma'am.
Madam Hearing Examiner, can you hear me?
Sure, I can.
I don't know if this helps at all, but an exhibit very similar to this, with language very similar to what we had discussed earlier in terms of the amortization periods and things, I do believe was included in Ms. Blotter's testimony in support of the settlement in the last case.
I missed the last sentence.
I believe an exhibit very similar. This was included in Ms. Blotter's testimony in support of the settlement in the last case.
In the last
I'm
case.
not 100% sure, but I do think that it was.
Okay, very well, sir. Thank you. And I believe I understand your supplemental testimony in support of the order requiring gas company to submit evidence and essentially for the record, you ran the cost model to include the proposed additional revenue required from the 5% merit because of the labor loss situation, as well as the 3.3 million from the new transportation contract, correct?
Yes, ma'am. Can I confirm which exhibit you're referring to? Is it
Sure.
exhibit 30? Is
I
that my,
am looking at. Yes,
okay. Yes, I agree with your statement. I ran the cost model for purposes of the errata.
and the sort of the result was, as you testify on page 9, line 17 and 18, the ultimate impact of these changes on the company's requested revenue requirement was approximately $940,000, correct?
Yes, ma'am.
And that was an increase or a decrease to the revenue requirement?
That was a decrease to the revenue requirement.
Well, it was fortuitous that when you're asking for more revenue for the 5%, that the transportation contract materialized that would offset that particular increase, isn't it?
It was.
And thank you for providing the actual location to those inputs. So that we could find exactly and follow the numbers.
I'm glad you found that helpful, the cost of service model. I have a printed copy here, and it's 2 giant 3-ring binders thick, so I can appreciate the question.
I can't move the camera, but I have those.
Yeah,
Yeah, old school with the notebooks that I put together, absolutely. But unlike you put it together, you know where to look. You know, I would have to look through every page and I still might not find it. So like I say, I appreciate that. I believe, sir, that those are the questions that I had for you. I thank you for your time, and Hearing Examiner Ryan, you have questions for Mr. Buchanan.
Just a few, thank you. Mr. Buchanan, I want to also talk about the paragraph or your answer on page 35 of your direct testimony, 29, and then GC 29.
and I'm sorry, what page number?
Page 35.
One moment. Yes, sir.
So that the question beginning at line 13 and then the answer, you know, I don't want to have to read the whole answer to
Sure.
save our court reporter from having to type a bunch of stuff. So, I mean, I guess this writing I found confusing. So I'm just trying to understand why it is you're incrementally adding on percentage increases. Why are you doing that?
So you found it confusing because it's a confusing circumstance. So I agree with you.
Okay.
So starting with the base period, New Mexico Gas Company provides typically a 3% annual merit in January. Because the base period overlaps with the prior year and the current year, in order to normalize that, we do a 1.5% merit to catch the first 6 months up with the fact that the second 6 months has a 3% merit in it. So that's a normalization adjustment. And then because the linkage periods have a 6-month overlap in them, we also do a 1.5% merit in the linkage periods to avoid double counting a 3% merit. Does that make sense?
I think so. Yeah. Okay. So in other words, I mean, at the broadest level, you're just trying to build into the future test year the appropriate amount of escalations without double counting at any point in time.
That's right. Well said.
Okay. And I thought it was kind of the typo messed me up too, because it says, because we, the base period, it sounds like we the people. That's like, wait, at line 17, there's an extra we in there.
You're right. Thank you.
It's inconsequential. Writing errors happen all the time. I make them all the time myself. But when I was reading the sentence, I was like, okay, this is confusing to begin with, but now I'm more confused. But in any case, all right. If you don't have an answer to this question, that's fine. It's a broad level question that actually doesn't necessarily relate to the exact application, because you guys have foregone the IMP mechanism and you just have the asset at this point. But I was reading your testimony at page 43 when you're talking about the rate riders 4 and 14, and you explain in the answer, you know, we exclude that from the company's calculation because rate rider 4 and 14 is activity is charged to customers through those mechanisms rather than in the cost of service or base rates. Would the integrity management mechanism, if it existed, be treated the same way?
I think it would be a little different because if we were to receive approval of the integrity management mechanism, we would every time we filed our next general rate case, we would take those assets that are sort of being collected for in the mechanism and put them into base rates.
Okay, and so why would you do that? I mean, and I understand your answer. I'm just trying to understand what's the justification for treating it? And I don't know enough about these particular rate riders to answer, but there has to be some differentiation that you would offer that would explain it. And I was hoping maybe you could do that.
Well, again, I think others in the case have testified to this, but the purpose of the IMP mechanism is to provide the company an opportunity to recover its investments, in more real-time fashion, and that once you filed a new general rate case over whatever horizon that might be, you would take the assets in that rider and move them into base rates. And I think that's similar to what other utilities might do. I'm not an expert on this, but for example, in maybe their renewable riders, where for example, they'll go and build a renewable facility that'll be included in a rider. Mm-hmm. And then at some point in the future, they will ask that those assets be moved into base rates.
Okay, and I understand it's sort of more just a theoretical question than anything, because it's not actually an issue in this case. So it was just a question that I had when I was reading that testimony.
Sure.
At 44, you say, the question is, why is New Mexico Gas Company excluding all revenues related to the AMA and storage agreements from the revenue requirement calculation? And you say, these revenues arise from assets associated with New Mexico's purchase gas adjustment clause, which is separate from rate base and operating expenses. And I just wanted a clarification. Is that basically because it's basically a pass-through cost for the cost of gas? Is that what's going on there?
Yes, that's right. That's right.
So you all don't realize any sort of rate-based benefit for passing those costs through. You're just basically charging the customers whatever the cost is. Is that the idea?
Yes, that's the idea.
Okay. And I had this tab and the same question, moving to your stipulation testimony, Mr. Buchanan, at page 6. You know, what Ms. Hurst asked you, she read aloud that first bullet point there, the specific adjustments which result in the stipulation COS schedules. And then that first bullet, you talk about adjusting rate base by setting net plant and on and on. The question I have when I write this is why did you start there? I mean, I'm sure there's a very simple explanation, but why did you do that in order to start the process?
Good question. And I'll sort of answer it in the converse. So if you look at the last 2 bullets in that paragraph, we're talking about the adjustments to our ROE and our capital structure,
Okay,
right? You can double count your calculations if you don't do things in order. So the first thing you want to do is adjust your rate base to where it belongs.
okay,
And then you want to adjust your ROE and your cap structure because they're calculated on rate base. So we try to have rate base related adjustments come first.
Okay.
We update things that are like the ROE and the cap structure.
okay. So adjusted to that first bullet there, adjusted rate base by first setting net plant and rate base amounts to the actuals existing as of December 31, 2021. And was that number, was that when the why that date? Why that date, December 31, 2021?
For 2 reasons. One was because you know, we thought it was a good point in time as a starting point, and also it aligns with an accurate calculation of our ADIT related to plant at that time.
Okay,
And so because it lined up well with taxes, and this was discussed with the tax team, we chose that as a starting point to make sure we had our ADIT and our plans in line.
okay. And I believe, Ms. Hurston, you discussed this, but I'll just follow up real quickly about the vacancy savings. So if you adjust, this is like the bullet point line 15 on page 6 there, adjusted the expected employee vacancies from 36 to 52, which had a reduction to the company's revenue requirement by some amount, almost, you know, $750,000. That number would go up if there were more vacancies, I assume.
I'm sorry, were you asking Ms. Hurst or
I'm
me?
asking you. I'm asking
Okay,
you.
okay.
Yeah.
It's accounting is funny when you say go up
Funny.
and go down. So the reduction in the revenue requirement. Wait, how do I say this? Our revenue requirement would be lower with higher vacancies.
Right.
But I think again, I
Yes.
stated earlier, there's a point where you
Yeah.
get to kind of a critical mass where you've got so many vacancies that you start paying for overtime. I think that's the situation.
Yeah, and you were correct that Mr. Sanchez brought that up in our discussions. You know, and I think as hearing examiner Hurstavai has asked several times in this case, you know, to some extent does the stipulation sort of, you know, whatever I think the expression is, cut off its nose despite its face. You know, you reduce to a point where you then end up having to spend more because you don't have the employees on hand that you need. Is that a concern? And is that a valid concern in this case, as far as you're aware?
No, I don't think it's a concern in this case in the settlement. No.
Okay. You know, then this is just a very general question. Over on the next page, when you talk at the penultimate bullet there, you reduced the requested ROE from 10.1 to 9.375, which reduces the company's future test year revenue requirement by $4,180,201. And I guess, you know, the numbers are also sort of in many ways astronomical in all these cases. You know, you see hundreds of millions of dollars. My question to you is, how significant is that future test year revenue requirement reduction of 4 million from the requested ROE adjustment? Like, how significant is that to the company?
I'm sorry, I'm not sure I understand.
Is $4 million a lot of money as far as the company is concerned?
Yeah, well, yes, absolutely. But I think that you have to take, it's very difficult to focus on any one thing in a settled case, because parties involved in that settlement are balancing and weighing every component of, what their concerns might be or what the company's concerns might be, and balancing those out. And so I think when you're looking at a settled agreement, what we're trying to achieve is fair and reasonable rates, and that you really have to look at every component of that together to come up with, the changes in revenue.
All right. And so I guess if you're, I'm just trying to put that number of 4 million into some sort of context that makes it coherent. So, in some ways you negotiate downward and the company takes effectively, to sort of speak colloquially, a $4 million hit on the return on equity to get the settlement. I mean, what does that practically mean for the company? I realize it's a very broad question, but I'm just trying to make
Sure.
sense of that negotiated reduction.
Practically speaking, it means we'll have lower net income.
Yeah.
But again, that was a consideration as part of the settlement.
Right. And I guess the next question is, which I won't ask you to answer because it's probably just beyond the scope of what could have been done, or where would that have gone, and what does that mean to the company? But I won't ask you to respond to those. You said in both instances, this is just with respect to amortization of the it's the rights of way, and then other items of amortization. They all have come out at 2 years, and it seems like 2 years seems like a number that I see quite a lot when I'm seeing amortization. Is 2 years some magic number? I'm sure it's not, but why is it always 2 years?
Again, I think what we're trying to do is balance out recovering those costs from ratepayers.
Mm-hmm.
So I gave that example earlier. If you recover them over 1 year and then you don't file, in the following year to update your rates, you continue recovering those costs from customers even though you've amortized them. And the reverse would be true if you chose a very long amortization period. So the company chose 2 years just as a balance to customers and to the company for the timing of that recovery.
Okay. All right. Thank you, Mr. Buchanan. That's all the questions I have. Ms. Hurst.
Thank you, sir.
Thank you. Mr. Haverly, any redirect for Mr. Buchanan?
No, ma'am, I have no redirect.
Does anyone have any questions based on my questions or hearing examiner Ryan's questions? No. Thank you, Mr. Buchanan.
Okay.
You are
Thank you.
excused.
Thank you very much.
Mr. Haverly, Mr. Dome?
Madam Hearing Examiner, that is the end of all of our witnesses in support of the stipulation.
Very well. I believe then that it might be appropriate, an appropriate stoppage point for our luncheon break. And my understanding of the proposed witness order that was in the pre-hearing memo would actually have CCAE, I believe CCAE witness Sullivan, coming next, and then Attorney General Witness Crane, and then New Mexico Area Witness Gorman. However, because FEA Witness O'Donnell is only available today, rather than worry about that, would it be appropriate for us to hear from Witness O'Donnell after our luncheon break?
Mayor Examiner, this
Aye.
is Peter Gould, Benham Area Council. That would be completely fine for us. If also we could kind of get some estimation from you and Mr. Ryan, whether Mr. Gorman should remain available for the rest of the afternoon, or whether he should just plan on attending the hearing in the morning. And we can do that after lunch.
Okay, we can
Thank
talk
you,
about that. Ms. Norval, would your witness be available right after lunch?
Yes, Madam Hearing Examiner, we can arrange that.
Okay, so that's sort of how I'm looking. Like I say, we can hear from Witness O'Donnell. And then next after that in your proposed order would be CCA Witness Sullivan, AG Witness Crane, and New Mexico Area Witness Mr. Gorman. And we will talk about proposed times. I guess then based on that, let's go ahead and take our luncheon recess, and we'll come back at 1 o'clock and hear from Witness O'Donnell. Okay, thank you. We are recessed.
Sorry.
While we're off the record, can I ask a procedural question?
Sure.
So what would be the appropriate time for our witness to try to enter the Zoom room?
You know, we can admit them fairly easily. So I mean, I think more than anything, it's just shortly before they're going to testify. I mean, I guess your point is you don't know exactly when that will be.
Or, I mean, I guess what I had in mind is like, is it when hearing examiner Hurst hands it off to hearing examiner Ryan? Because then like, that's kind of a signal that's like almost their time, or like, I don't know. You just tell me what to do and we'll do it.
No, I know. I understand your point. You know, they can enter into the waiting room as soon as they wish, and then they'll just appear as a waiting room attendee. And yeah, I mean, obviously Elizabeth has always been, you know, questioning first, and then I'll go second. So I think that's a fair. But I think, you know, if they just sit in the waiting room, it causes no consternation to anybody. So I hope that's a satisfactory answer.
Yes, thank you.
Or you could go first for a while if you want.
No, that's okay. No, Ms.
You
Gerson
want
was.
to mix it up?
Ms. Gerson was just asking if when their witnesses should enter the waiting room, and it's a fair question since we can't say exactly when, you know, when one will end and the next will go. So they can just sit in the waiting room was my answer, but they can probably predict when they'll be needed.
Okay. Excellent. So I guess there's Mr. Lee. Are you ready, Mr. Lee?
Yes, ma'am.
Awesome. Great. Let's go back on the record then. We're back from our luncheon recess. And anything you want to address, hearing examiner Ryan?
Yeah, so during the luncheon break, this is for Mr. Dome and Mr. Haverly. Hearing examiner Hurst pointed out to me, I understood Mr. Morin, Dr. Morin's offer to have a free book to be just a very generous thing, and seems like a very nice gentleman. But sadly, the New Mexico statutes preclude commission employees from receiving gifts from interveners. And you know, so if you could pass on to Dr. Morin that's very nice of him, but I'll just have to buy the book.
We agree, and we will talk with Dr. Moran about it.
But let him know we appreciate the sentiment
Yes.
and understood it was just a nice act of generosity. So
Yes, we will explain the whole thing, and we will tell him that you appreciate the offer.
thank you.
And Brian, you can have him send that book to me.
I'll let him know, Peter.
I have under no such restrictions.
I don't know if that was in the stipulation, so you'll have to discuss that outside of the hearing.
I almost jumped in and requested one to create a balance among the parties. Was going to be my approach, and my tongue very hard for a minute there.
Well, it's all we're being jovial about it, and that's good. And but yes, pursuant to 8819, which we take very seriously, and hearing examiner Ryan had not come up against that, and we had a discussion, and as he's indicated, very gracious of Dr. Moran.
Madam Mayor, you
Klein?
could probably donate it to the commission and put it in your library. I know that you have a little regulatory law library someplace.
Not anymore,
Not anymore. Okay.
Mr. Gould.
Those are the old days. Okay.
I'm not aware of, after being evicted, we're lucky to have an office. I'm not aware of any library anymore, unfortunately. So with that, let's go ahead, and I believe we are going to continue our hearing. Gas company has rested in its presentation, and because of time constraints, we are now going to call FEA witness O'Donnell.
Madam Hearing Examiner, just a moment. Did you have the opportunity to confer with Mr. Ryan, and can you provide me with an update on any message I should communicate to Mr. Gorman?
We did have an opportunity to have a discussion, Mr. Gould. I don't know if it's going to be a satisfactory answer, but
Okay.
we do, we have some questions for the witnesses that are ahead of Mr. Gorman. And, we've been proceeding pretty expeditiously today. I think there's a chance we could get to him. However, we do have, both of us have questions for Attorney General Witness Crane.
Okay.
And depending on how long that takes, we could see Mr. Gorman today, or it would be first thing in the morning.
Okay, I'll communicate that. That's fine. Thank you so much.
I realize that, that's
No,
kind of wishy-washy, but
No, this is how these things go. It's more important to get the evidence in that you need to get in. So I will communicate that to him, and thank you for your consideration.
thank you. Ms. Norval, you have a witness.
Yes, thank you, Madam Hearing Examiner. The federal executive agencies call Mr. Kevin O'Donnell.
Good afternoon, Mr. O'Donnell.
Good afternoon.
Mr. Lee, would you swear the witness, please?
Please raise your right hand. You solemnly swear the testimony you're about to give in the matter not pending should be the truth, the whole truth, and nothing but the truth, so help you God.
I do.
Thank you, sir.
Thank you.
Go ahead, Ms. Norval.
Mr. O'Donnell, could you please state your name and employer for the record?
My name is Kevin O'Donnell, and I'm employed with Nova Energy Consultants in Cary, North Carolina.
Thank you. And Mr. O'Donnell, do you have before you your settlement testimony dated May 31st, 2022, marked as FEA Exhibit Number 1?
Yes, I do.
And was this testimony prepared by you or under your direction and control?
Yes, it was.
And do you have any corrections to your settlement testimony?
No, I do not.
And is this testimony true and accurate to the best of your knowledge?
Yes, it is.
And if I asked you these same questions today, would your answers be the same?
Yes, they would.
Next, let's turn to your testimony in response to bench request. Do you have before you your testimony in response to bench request dated June 6, 2022, which was filed June 14th, 2022, and is marked as FEA Exhibit Number 2?
Yes, I do.
Was this testimony prepared by you or under your direction and control?
Yes, it was.
Do you have any corrections to your testimony marked as FEA Exhibit Number 2?
No, I do not.
And is this testimony true and accurate to the best of your knowledge?
Yes, it is.
And if I asked you these same questions today, would your answers be the same?
Yes, they would.
Finally, let's turn to your response to the June 22nd, 2022 additional bench request. Do you have before you your work paper in response to the June 22, 2022 additional bench request, which was filed on June 24th, 2022, and is marked as FEA Exhibit Number 3?
Yes, I do.
Was this document prepared by you or under your direction and control?
Yes, it was.
And do you have any corrections to this document?
No, I do not.
And is this document true and accurate to the best of your knowledge?
Yes.
Thank you. Hearing examiners Hurst and Ryan, the federal executive agencies move for the admission into the record of Mr. O'Donnell's settlement testimony marked as FEA Exhibit Number 1, Mr. O'Donnell's testimony in response to bench request marked as FEA Exhibit Number 2, and Mr. O'Donnell's work paper in response to the June 22nd additional bench request marked as FEA Exhibit Number 3. Copies of FEA Exhibits 1 and 2, as just identified by Mr. O'Donnell, were uploaded to the Dropbox last week. However, pursuant to hearing examiner Ryan's June 22nd bench request, we did not upload FEA Exhibit Number 3 into the Dropbox, but served a copy on all parties on Friday, June 24th, as instructed during our pre-hearing conference.
And I'll make sure that that document gets to our court reporter so he has it for the official record.
Very well. Anything further, Ms. Norval?
No, nothing further.
Very well. FAA Exhibit 1, the settlement testimony of Mr. O'Donnell as verified by him here today and pursuant to the non-objection agreement, as well as the verification from FEA counsel that the correct copy of FEA Exhibit 1 is in the Dropbox. FEA Exhibit 1 is admitted. FEA Exhibit 2, Mr. O'Donnell's testimony in response to the bench request as verified by him here today, and with the verification from counsel for FEA that the correct copy of FEA Exhibit 2 was put into the Dropbox, and subject to the non-objection agreement of the parties for all exhibits, will be admitted. FEA Exhibit 3, the supplemental work papers of Mr. O'Donnell as served upon the parties as verified by Mr. O'Donnell, subject to the non-objection agreement, and with the understanding that the hearing examiners will make sure that the copy sent to us of FEA Exhibit 3 is sent to the court reporter. FEA Exhibit 3 is admitted. Ms. Norval?
Thank you, Madam Hearing Examiner. The witness is now available for questioning.
Very well, thank you. Good afternoon, sir.
Good afternoon.
I've got a few questions for you, but I wanted to start out. I didn't see any inclusion in your testimony of your education and work experience. Did I miss that?
No, I don't think you did. It's not included in the settlement testimony or in FEA 2, so that's an oversight. We apologize.
Well, tell me about yourself.
Okay. I'm a graduate of NC State University with a degree in civil engineering. Then I went to Florida State, get an MBA in finance. Then I came back and worked for the public staff of the North Carolina Utilities Commission for 7 years. And that's basically the consumer advocate in North Carolina utility rate matters. And during that time, I became a chartered financial analyst, CFA. And since about 1991, I've been working in the consulting business with the last 26 years, I think of it, on my own, in my own company.
So you're the only employee of your consulting company?
I have one other employee beside myself.
Okay. And you're an engineer?
No, I'm more of a finance person, a financial analyst. The MBA in finance and the CFA. And when I went to work with the public staff of the Utilities Commission in North Carolina, I was a financial analyst, and I've always stayed in utility rates. But I do have the engineering background as well.
Okay, because I thought you said you had an engineering degree from NC State.
I do. I have an engineering degree and an MBA in finance.
And normally, what kind of clients do you testify on behalf of?
Normally,
Or provide your consulting service to?
we have two lines of business. Basically, we do wholesale power supply deals around the Carolinas, and those sets of clients are municipalities and universities. We've done about 30 wholesale deals over the past 26 years. The other half of my business, we do expert witness litigation, where I look at cost of capital, utility rate design, cost benefit analyses involving grid mod and plant investments, and basically finance related, utility rate related work. My clients on that end are typically consumer advocate groups, the federal executive agencies, and some industrial groups as well.
Do you ever do any consulting for commissions?
Yes, I'm currently working on a case in Georgia, and I have done work for the Wisconsin Public Service Commission as well.
I don't recall, sir. Have you testified here in New Mexico before?
No, I believe that I did work in the 2019 case, but that case was settled. I did not testify in that case. So this is my first time testifying before your commission. I am very well aware of New Mexico and been there several times up at Philmont myself, Philmont Scout Ranch in the northeast corner of your beautiful state.
Well, you need to just come down a little further south. Perhaps you could hang out with Dr. Warren. He says that he likes the artistic part of Santa Fe.
Okay, well, I'll definitely keep that in mind. It's a beautiful state, and I definitely loved my time up in at Philmont.
Excellent. So you did participate in a rate case. The 2019 gas company rate case, case number 19-00317 UT, correct?
That's correct, but I did not get on the witness stand in that case.
And I know in your testimony on page 2, you indicate in response to, you have any comments on the stipulation? On line 5, you say that a significant concern of FEA was the cost of service study, correct?
That's correct.
And it looks like in reading your testimony that, if I'm understanding it correctly, you don't care for the use of a future test year?
It's not necessarily that, it's the methodology itself of how you allocate mains, the replacement cost methodology versus
I'm
the
sorry, of
historic
how you allocate mains?
mains, yes, MAINS. It's the methodology, replacement cost methodology versus historical cost methodology.
And what troubles you about that?
The company has used the replacement cost methodology in this case and in the previous case, but that was a break from what they had done in prior cases where they had used the historical cost methodology. And it's my opinion that historical cost is more accurate of the way that the gas system has been built out, as opposed to the replacement cost methodology. The historical cost basically mirrors, better tracks the way that the mains were put into the ground on the historical cost methodology, as opposed to the replacement cost, which is all those assets are totaled up and priced at current prices. In other words, the cost, what would it cost to replace that system as it is today? Whereas I'm looking at what's the book historical cost and how do you allocate mains accordingly?
Do you have any explanation for why they changed their methodology in the last rate case?
No, I believe that that was Mr. Yardley's professional opinion. But it is not what I would recommend, and it is not what I would present to you.
So you think this methodology results in a inflated cost allocation for Maine?
For rate classes 56 and 58, which are the rate classes that the federal government takes its gas under, I believe that that methodology, the replacement cost methodology, allocates too much of the mains cost to 56 and 58. And that in turn drives the class rate of return down, as opposed to the historical cost methodology, where you would have fewer mains cost allocated to those two classes, and correspondingly, you would have a higher customer class rate of return.
What's the justification for the higher allocation to those rate classes?
Well, that would be Mr. Yardley's methodology. My argument is for use of the historical cost methodology is let's track the way that the system was built out. And it was built out over history. And if we have those historical costs, let's use them. I think that tells a greater story, tells the history of the gas system, as opposed to looking at all the mains, the feeder mains, and then allocating them based upon the current cost or replacement cost. If we have that historical cost methodology, I think we ought to use it.
No, I understand your point, sir. I'm just wondering. That you think the replacement methodology allocates too much to your clients' customer classes. And I'm just, and you think that's more accurate to use the historical. I'm just wondering what the justification for that replacement cost allocation. Is it the way the calculation is done?
Well, it's the way that, yes, well, the way that the calculation is done results in the different allocation amounts and therefore the different class rates of return. But that's just a means to an end. I go back to what's the methodology and why are you doing it? And Mr. Yardley's professional opinion is replacement cost. I disagree with him respectfully. I use historical cost. I think that the way that the system is built out is important. He takes all those costs and brings them up to current cost. That's not something I would do, but I respect his opinion, but that's not what I would do.
Okay. Well, while it may negatively affect rates 56 and 58, is replacement cost methodology, does it favor some rate classes over others?
Yes, it would favor.
Go ahead, sir.
It would favor residential customers, smaller customers, as opposed to the larger customer.
Isn't that the historical nature of rate setting, that some of the customers, especially the smaller customers, are subsidized by the larger customers?
I would say, in my experience, everything that we try to do in my 37 years in this business is that we try our best to do cost-based allocations, and we try our best to make certain that no class gets, that no subsidies exist. Now, we can't always do that, and it doesn't always appear that certain orders are come out in that manner, but I can tell you that it's the goal to have cost-based regulation.
Well, it's just, I've been hearing for decades, sir, that, the business classes and especially the large industrial users, have always said, well, we're paying more than our fair share and we're subsidizing those residential ratepayers. And, for example, in this case, sir, if you look at the proposed rates that gas company offered initially, both for 56 and 58, they were proposing a 26% increase, correct?
Correct.
And 20.5 for rate 10, the residential class, correct?
Correct.
And having a 20.5% increase for residential customers, I don't think necessarily would have been welcomed by the 90% of gas companies. I think the testimony is that 90% of their customers are residential ratepayers. Would it?
No, and I understand that completely. I mean, you were asking me earlier about my background, and I can tell you that 2 weeks ago, I just went forward and recommended another 15% rate hike to a municipality that has 95% plus of its load are residential customers. And they're at the poverty level or below. So, and I will tell you, I got a talking to. It was not a pleasant experience.
To go in person, or were you on Zoom?
Absolutely. No, it's close enough to my office and my house where I went in person.
You're brave.
But I understand exactly what you're saying, but I'll say to you what I told that board, and that is, it's awfully painful to come with news like that. But at the end of the day, my task, my job is to attempt to develop cost-based rates. And in this particular case, I understand the rate hike to residential customers. But again, my task is cost-based rates and let things fall out where they may. And I think that's what we attempted to do here with my cost allocation methodology as opposed to Mr. Yardley's.
And I appreciate that, sir. And I am not an elected official, but I work for 5. So obviously you understand after decades in the business that how certain rate classes, I mean, obviously all rate classes, but certain rate classes seem to trigger a more scrutiny perhaps than others. And ultimately, sir, in what was agreed to with the stipulation, the 26% proposed increase for rate 56 came down to 9.7, and the 26 for rate 58 came down to 9.73, correct?
That's correct.
And 9.65 for the residential rate class.
Yes.
And I heard testimony earlier in the week, and I think it was something to the fact that none of the rate classes experienced an increase that was more than 5% above or below the system average increase. Does that sound right to you?
It sounds about right. Yes, I think I remember something to that effect.
Why is that important? Why do parties keep talking about the spread in the average as being some important measure?
Because you're going to have different rate increases that are going to be adjusted over time. I'll give you an example. When I first started working for the public staff of the North Carolina Utilities Commission, we had customer class rates of return that were in excess of 50%. But we knew that those customer classes could not all of a sudden be brought down to parity immediately. So what we did was we slowly, over time, started chopping down that those rate increases and implemented some rate decreases, so that over time, what we felt like where a customer class was subsidizing another, we would fix that. But we did it over time. And here, to your question directly, I think that's what we're trying to get in the stipulation, is that there are some inequities, and I point to the use of the historical cost versus the replacement cost. But we need to get to where we want to go over time, and I think this stipulation does that.
Have you been listening to any of the hearing this week, sir?
Some of it, yes, I have. Not all of it, but some of it.
Well, I seem to have a particular interest in the number of and frequency of rate cases. Gas company has filed 3 in the past 4 years, and they're gonna file their next one, I believe, at the end of 2023. And does the frequency and number of the rate cases for this particular company give you any concern?
Not really, and I will answer it like this from a customer standpoint. Again, I'm going to go back to these small towns that I represent on the electric side in East North Carolina. What everyone wants is rate stability. You don't want massive rate increases, and while you may have an opportunity to do massive rate cuts, that's still not in the best interest of folks. So, because, if you do a massive rate cut, then sooner or later it's going to come back, you're going to have a massive rate increase. So over time, you'd like to have stability. So to the extent that the gas company stays out for an extended period of time, and the rate increase that they are seeking, say after 5 years, is going to be 30 or 40%, I would rather have them come in after a period of 2 or 3 years, where the rate increase instead of being 50 is going to be more in the neighborhood of 20, for example. It's easier for everyone to swallow, and it's also easier for most businesses to budget. And individuals. It's really hard to budget when you got a 50% rate hike.
Unless they stay out because they're over earning.
I can't speak for the gas company in New Mexico, but there have been other situations where that argument has been made that I'm aware of.
I have seen it and heard about it in the electric industry. And I think it sort of resulted in calls for periodic reviews instituted by the commission, potentially. Ultimately, sir, your conclusion in your testimony is that you believe that the settlement's fair and it results in just and reasonable rates. Ultimately, what did you base that conclusion on?
Well, FEA looked at everything that was provided to us. And at the end of the day, and as you can tell, I've been in this business for a long time. At the end of the day, you make a judgment call and ask yourself, is this the best that we can get? What are the risks of not settling? And we determined that for our customers that this was reasonable and that we would accept it. I can't point to any one specific item other than to tell you that it was a judgment call based upon everything in front of us, and that's not very specific, but that's kind of how it went for us anyhow.
All right, sir. And I believe that there's going to be some questions about your bench request response, but I just have one question on that for you. So, sir, if you look at your FEA Exhibit 2, on page 3, you testify by approving it's line 13, by approving the stipulation, the commission will not be impeded from considering the accuracy of gas company's future test year forecasts in the next case, nor is it likely that gas company will recover amounts in excess of its actual plant in service in this case as a result of the stipulation. That's your testimony, sir?
Yes, yes, it is.
Did you hear them testify earlier in the week that they actually exceeded the rate of return that they agreed to in the last rate case?
No, must have been an area of the case I did not hear.
Okay. Does that change your answer at all?
No, and I will tell you that it's probably not too surprising because the amount of plant that they put in service was a little bit lower than what they had planned. For whatever reason that may be, COVID or whatever. So if you have a lower denominator, then your percentage is going to be higher. So that may very well explain what happened. I don't know that for a fact. The gas company couldn't explain it, but that would be my guess.
Do you participate primarily in electric or gas or both?
It's both.
Do you consider based on your knowledge and experience, is gas company a typical LDC?
Yes, it is. One difference may be, its parent holding company, Emera, is based in Tampa. A lot of the gas utilities nowadays are owned by big electric companies. So it's a little bit different in that respect. But overall, the LDC itself, I would say, is fairly typical of what I've seen.
Okay. I thank you, sir.
Thank you.
Hearing examiner Ryan, do you have questions for
Yes.
Mr. O'Donnell?
Yes, I do. Hello, Mr.
Please,
O'Donnell.
sir.
How are you?
I'm good, sir. How are you?
Okay, thank you. As you were speaking with Ms. Hurst, hearing examiner Hurst, I noted you said at one point that your cost allocation, or you were just setting up a juxtaposition, your cost allocation versus Mr. Yardley's. But, and I'm not saying this as a fault of anything, but we've not seen your cost allocation, correct?
In this particular case, no, but
Right.
it's what the company had used in cases prior to 2019.
Sorry, that's your call. All I want to know is you did a cost allocation in this case. Is that correct?
Yes, work papers that, we never filed direct testimony, but there
Right.
were some back work papers.
Yeah, no, I'm only asking because, as Ms. Hurst said, speaking to one of the former witnesses, the challenge of a stipulation is it keeps us from knowing much of what you all know. So we've not seen those papers. So I was wondering, Mr. O'Donnell, if you could just briefly describe for me, what it is you did in preparing your analysis. I mean, to reach the conclusion you came to in this case that the settlement was a good result, just for the benefit of the commission.
Okay. So you don't, let me correct, let me make certain I understand what you're asking. You're not asking me to describe the methodologies that I examined, but instead talk about why I came to the conclusion that the stipulation is acceptable.
Yeah, well, I want to know also too, what work is that you did that led you to that conclusion? I mean, I don't ask you to get into any great detail,
Okay.
but just to give an overview of the analysis you performed, and then say, this is the basis for my conclusion that this settlement is a good deal.
Okay. So when we were first brought into the case, we knew ahead of time that this mains allocation would be an argument in the case, because it was in the previous case. And so the company's FACOS model, its fully allocated cost of service model, is in detail, and the company offered to run various scenarios of its FACOS model for us. So based upon that, we took them up on that offer, and they ran some scenarios for us based upon my preferred replacement cost methodology. And we got the results. And as expected, our customer class rates were returned for 56 and 58 were higher than what the company's methodology came out to. That was fully expected, fully anticipated. And so as we moved on down the road and talked about settlement, we offered up some numbers, and then other interveners offered up some numbers. Gas company offered up some numbers. And at the end of the day, as I was saying to Ms. Hurst, I can't point to any one specific item and say, well, this made it fair. But what I can say is that we looked at the possibility that perhaps we would get a rate increase higher than what the stipulation says. And we, like I'm assuming every other intervener in the case, we weren't exactly happy about that kind of a rate increase. But I'll paraphrase a good friend of mine who's a judge right now, and he once said, if he can walk away from a case and everyone's mad at him, then perhaps he did a good job. And that's kind of how stipulations go. We're never happy for a rate increase, but we look at it and we look about the risks, and we determine that this is in the best interest of FEA to move forward.
You were discussing with hearing examiner Hurst the historical cost method versus the replacement cost method for allocating mains. I just wish to have a few clarifications in terms of terminology there. So when you talk about allocating mains, the mains to which you are referring are what?
They are the backbone of the gas system. They differ in size, I think between 2 inches and 8 inches. They are typically plastic. The gas company does have a few steel mains in place, but it's basically the backbone of the system.
So is that a big percentage of the system itself?
Yes, it is.
So I take it that the way one elects to allocate the main is something of significance because it's probably I guess it's a significant portion of the whole system.
Yes, definitely.
Okay, I just want to. I'm trying to understand basic conceptual things here, so you can just work with me.
I understand.
So the historical cost method you talked about, you're saying how it was built in history. So for instance, we would look back if a main was laid in the 70s, you theoretically would what, go to the receipts of the 70s or whatever the costs were back then?
Yes, we sent a data request to the gas company and asked for the sum of the average cost of the various main sizes. So what they did was they went back and they looked at the book value of all their 2-inch mains, all their 4-inch mains, all of their 6, 8, all the various sizes. And based upon that, a percent split was made between the customer component and the demand component. And then those mains were then split up between customer component and main component. And the more that went to the customer component would mean higher residential allocation and lower to larger customers, historical customers like FEA. And, you know, when you think about it, and this is my argument to Mr. Yardley, when you think about it, that's probably the most accurate depiction of the way gas systems are being built out, because you've got residential customers that are coming online more so than you do large industrials or FEA, for example. So it would only come to reason that more of the mains would be allocated to residential customers under the historical cost than opposed to the replacement cost.
Okay, but I guess just for purpose of clarification for myself, when you use the words historical cost, are you referring to a dollar number for main, or what is that term that you're using there?
It is a dollar amount average historical cost per foot of the type of main.
Okay, and then when you're talking about replacement cost, I mean, the alternative would be like what under present technology, which I understand, you know, piping technology has improved greatly in the last however many years as part of their case. And this is the integrity management mechanism to deal with some of the, I guess, inferior pipe that exists out there. What is the basis for a replacement cost? Like, what do they look at?
They looked at present value cost. So for example, I'm just going to use an example. If the current cost of a 2-inch main, let's pick a number, is $3 a foot, whereas with historical cost, it may have been $1 a foot, then you can see how that would impact, you know, replacement cost versus historical.
Okay, all right, I think I follow. So in your response to the bench request, you did note that your FEA had done what appeared ultimately in the recommended decision. I know Hearing Examiner Schanauer was cataloging that you had made this request in the 19317 case, and that was the writing that I cited in the bench request. But you went ahead and did this. You discovered that it was a 13% exaggeration in terms of the core company's forecasted expenditures. Is that basically what I'm reading there?
They underbuilt by 13.8%. You know, their forecast may have been accurate. I can't really speak to why they didn't put that plan in the ground, other than perhaps it was COVID related. Getting supplies during COVID may have been very difficult. But in any event, they did not put the amount of plant in that they had forecasted for whatever reasons there may be.
Okay, so and I'm just highlighted that portion of your testimony on page 2. This is FEA Exhibit 2. Based on FEA's evaluation, I determined that New Mexico Gas Company's actual expenditures for the year ended December 31, 2021 were at least 13% below the company's forecasted. So in other words, they have a projection, and the projection was high by 13%.
Yes.
Okay. And then I asked, as a follow-up question, I thought, well, okay, that's interesting. You know, perhaps there will be some dispute about this point, and you know, I could anticipate someone saying, well, we don't agree, blah blah blah. So I said, well, Mr. O'Donnell and FEA, if you all could please submit, you know, how you reached that determination. And then you guys submitted what is FEA Exhibit 3. And I was wondering if you could just help me very quickly understand the two columns and what this document does in terms of laying out numbers there.
All
So,
right.
so could you just tell me, so I see the first column on the left is entitled Plant Clearings July 2019 through December 2021. So what, how does that relate to the 2019 rate case and that future test year projections there?
So what they forecasted was actually in column 2,
Okay,
which sums down to roughly $292.3 million. What actually occurred is in column 1,
okay,
253.5. So
Gotcha.
we take those two different numbers and it comes out about 13.8%.
13, is it 13.8 or 13.28?
13.28, excuse me.
Yeah. Okay, that's what I thought was going on. I was kind of, I was curious. I sort of thought you would reverse them, but I see how the columns work.
Right.
Okay, and then I guess when you discovered this, what was your reaction to this? Was this anticipated? Were you not surprised? Were you, what any comment?
My first thought was COVID. Honestly, that's kind of what I thought happened, is that it is hard for me to understand why a utility does not want to grow as much plant as possible into the ground, because quite frankly, they make their earnings on plant and equipment invested. So when I looked at that, I said, well, I wonder what happened there. And then I remember the times that we were in, and I said, well, it's probably COVID related, but I didn't dig any further than that.
So, and I read it, my initial thought was, and, I guess I grew up in New York City, so I don't trust anyone, cynic by nature, would be, well, okay, so it's a future test year in the 19317 case, and perhaps they overprojected, and that could have happened for a whole host of reasons. And that was just an overprojection. You don't think that was the result?
It very well may have been. And I can tell you that over forecasts do happen, but I will also say that to the extent that you have rate cases coming in once every 2 or 3 years, that's how you true those over forecasts up. I can't tell you exactly what happened in 2019 to cause the over forecast, but I know it's being addressed in this case.
Okay. Thank you, Mr. O'Donnell. That's all the questions I had, Ms. Hurst.
Thank you.
Thank you. Ms. Norval, any redirect of your witness?
No redirect, Madam Hearing Examiner. Thank you.
Very well. Any questions from any party based upon Hearing Examiner Ryan's questions or my questions? Hearing none. Mr. O'Donnell, thank you very much. Appreciate your time, sir. And you're excused.
Thank you. Y'all have a good rest of your day.
And the same to you, sir. Anything further, Ms. Norval, from FEA?
No, nothing further, Madam Hearing Examiner.
Thank you. I think then, based upon the proposed order that we will go back to, I believe that CCAE has witness Sullivan.
Who's just been admitted.
Thank you, hearing examiners.
That Ms. Gerson? Was that Ms. Gerson who was speaking?
No, this is Kara Lynch, attorney for CCAE. I'll be presenting our expert witness, Dylan Sullivan.
Very well, go ahead.
Okay, welcome, Mr. Sullivan. CCAE. What?
Hello, I need to swear the witness.
Yes.
Sure.
CCAE calls Dylan Sullivan.
Go ahead, Mr. Lee, if you would swear the witness.
Mr. Sullivan, would you raise your right hand? You solemnly swear the testimony you're about to give, the matter not pending, should be the truth, the whole truth, and nothing but the truth, so help you God.
I do.
Thank you, sir.
Good afternoon, Mr. Sullivan.
Good afternoon, hearing examiner.
Very well. Go ahead, Ms. Lynch.
Thank you. Thanks for being here, Mr. Sullivan. Could you please provide your name and place of employment?
My name is Dylan Sullivan, and I am employed at the Natural Resources Defense Council.
And what position do you hold with NRDC? What is your title and what do you do?
I am a senior scientist on the policy analysis team at the Natural Resources Defense Council. So I work with policy advocates in regions in the West, sorry, to work with them to do policy analysis about priority areas with a focus on the regulated gas and electric utilities. And I also do some work on energy modeling, on how we can meet greenhouse gas emission reduction targets in a cost-effective and hopefully equitable manner.
Thank you. And do you have before you the testimony marked exhibit number 1, testimony and exhibits of Dylan Sullivan on behalf of Coalition for Clean Affordable Energy supporting unopposed stipulation?
Yes, I do.
Was this testimony prepared by you?
Yes, it was.
And all of the information contained within it was under your control?
Yes, it was.
Okay. Do you have any corrections to make to this testimony?
No, I don't.
So if I were to ask you if your answers that you provided in this testimony are true and accurate, if the same questions were asked today, what would you say?
I would say yes, they still are.
Thank you. Do I pass the witness, Ms. Hurst?
You just need to verify for me, Ms. Lynch, that CCAE Exhibit 1 as verified by Mr. Sullivan was in fact downloaded pursuant to the order into the Dropbox.
Was the testimony and exhibits marked Exhibit 1
No,
for?
you tell me.
Oh,
Did you do it?
I'm sorry, I thought you were asking me to ask
No,
Dylan.
no,
Yes,
no.
yes, I did. And there is one issue with the testimony as it was uploaded. It appears that 2 files may have been uploaded. They're exactly the same. The only difference is that I relabeled the second one as Exhibit 1.
Okay.
I can confirm that's the case, Ms. Hurst. I'm looking at it right now.
Okay. All right, well, so we've got 2 of the same thing. So very well, we just needed one that answers that question. CCA Exhibit 1, Mr. Sullivan's testimony in support of the stipulation as verified by him here today, subject to the no objection agreement of the parties and the verification from counsel for CCAE that CCAE Exhibit 1 had in fact been downloaded into the Dropbox will be admitted.
Thank you.
Do you pass the witness, Ms. Lynch, for some questions?
Yes, I pass our witness.
Very well. Good afternoon, sir.
Good afternoon, hearing examiner Hurst.
and welcome to testifying before the commission.
Thank you.
Have you testified before other public utility commissions?
Yes, I have. I think on 17 prior occasions, as described in my statement of qualifications, which is attached, I think is attachment 1 to my testimony.
Tell me some of the states.
Well, I worked in our Midwest office in Chicago when I started at NRDC. So I have testified a lot in Ohio, once in Indiana, once in Minnesota, once in Illinois, I also believe. So
Okay.
yeah.
What and what kind of cases were you mainly or issues were you providing testimony on?
Yes, I was mainly testifying on demand side management programs and mostly in the electric context. And I was also testifying on decoupling for both gas and electric utilities. Since I went back to grad school in 2019, I think I broadened my expertise to focus more on emissions analysis, in addition to some of the issues I testified on before. So that's primarily what I'm testifying on today.
Yeah, and that was actually my question, my next question, sir. Would it be fair to say that your focus and the focus of CCAE in this case was primarily related to paragraphs 21 through 27 of the stipulation?
If those are the paragraphs that refer to environmental and emissions issues, which I just have to switch tabs, then that is correct.
And 21 through 25 are under the heading of greenhouse gas emission reduction initiatives in this case. And
Yes.
then additional provisions label for 26 and 27. But those relate, my understanding is it says 26 relates to a compliance greenhouse gas emission filing from the prior case. And then a modification to rate 39, I believe, which also has to do with compressed natural gas.
Yes, yes. So
okay, that was your focus here.
yes, it was.
Okay. And am I correct that by signing off on the stipulation of that you believe that you achieved what you had hoped to with regard to greenhouse gas emissions in this case?
I thought that the stipulation was a fair settlement of the greenhouse gas issues in this case.
I noticed your educational background. It says you have a master's in public policy and a master's in civil and environmental engineering. That's correct, sir?
Yes.
Do you have any training in finance or accounting or economics?
I have training in economics at Princeton. Basically, I think of my Princeton year as just a year of policy relevant economics. So I took a couple of courses related to public economics. I took a regulatory economics course, environmental economics course, econometrics also. So I have some graduate training in economics, but not in finance or accounting.
Oh, are you familiar with the cost of service modeling that is done, or rate design?
I am familiar more with rate design than with cost of service modeling. Yeah. So I'm not unfamiliar with rate design, but I wouldn't want to testify to it.
Okay, well, you did. Actually.
Are you referring to the CNG stations?
I'm referring to your testimony on page 23. The question posed at lines 2 and 3. Is the unopposed stipulation consistent with the public interest and just and reasonable rates? And you testify, yes, it is. So my question to you is, what analysis did you do to reach that conclusion?
It's I testified a lot on the issues in the paragraphs that we previously talked about, on the environmental issues in the stipulation. So I did a lot of analysis on those issues that's described in my testimony and in its attachments. And I start my testimony by saying I'm primarily focused on those aspects.
I understand that, sir, but when you testify that you think the stipulation results in just and reasonable rates, then I'm going to have to know why you think that that a 10% increase to residential rates is appropriate. As well as all the other increases, and that the $19.3 million revenue requirement is appropriate.
And I think what gave me at least some small comfort there was as I talk about in my testimony, the avoidance or delay of a potentially costly phase 2 hydrogen pilot, and also the company's analysis of electric vehicle purchases that could reduce its ongoing operational costs.
Well, would you agree with me that just because the company is agreeing to delay potentially a particular costly problem that in your mind might also be an environmental problem, that agreement to delay that doesn't necessarily mean that the increase that they're going to get based upon some agreement results in just and reasonable rates, does it?
Yeah, I would agree.
I believe that's all the questions that I have for you, sir. Thank you. Hearing Examiner Ryan, you have questions for Mr. Sullivan?
I do, yeah. I wanted to share the screen here a second, Mr. Sullivan, and I will, I'm going to bring up, this is Mr. Westine's responses to my bench requests, and that would be New Mexico Gas Company number 14. And I'm going to share the screen.
Okay.
And you should be seeing some yellow highlighted text there.
Yes, I see what you're
Great.
highlighting.
And then, so that's, just for the record, I'll just note that that's page 13, lines 1 through 8 that I've highlighted with yellow. I won't read it all for the benefit of our court reporter, so he doesn't have to write all that down. But I wish you could, I would ask you to please read that, Mr. Sullivan, and then just let me know when you've finished.
I am finished.
Great. So my basic question is, do you agree with what Mr. Wessina said here?
I do not, and I think a lot depends on specific geographies and the degree to which how many heating degree days there are, for example, and also of course, like what the goal is, what the objective is. So if we're trying to reach net zero emissions in a cost-effective manner, then I think he's referencing an E3 pathways analysis. There have been several E3 and other pathways analyses that have shown an opposite conclusion, that the electrification strategy is the best one for customers and for meeting climate goals. So I'd point to E3 for California, also Evolved Energy for Washington State. And the reason that electrification comes out on top is because you can benefit from relatively low cost renewable energy resources, and also to just highly efficient end uses of electricity in the form of heat pumps and electric cooking.
When I was somewhat surprised when I read the testimony, and I'm just more saying this, I'm not an engineer or a person who's spent considerable portions of my life trying to figure out, questions about how to make natural gas less emissions heavy, for lack of a better word. But you hear and you read about people trying to blend natural gas and hydrogen. And so when I read the intervener testimony and saw, what seemed to be almost uniform opposition, I was a little surprised. And I guess my question is, and I think I may have asked this, but I'll ask it again. I didn't ask you specifically, but perhaps I just ask you again now. Or, is there any merit to that project?
In my opinion, there's not merit to that project, and I think the biggest reason is and I'm speaking specifically about phase 2 here.
Okay.
The reason is the source of the hydrogen itself. That's the primary reason. So I describe in my testimony the results of an emissions analysis where I basically replicate Professor Mark Jacobson's analysis and Professor Howard's analysis of the greenhouse gas emissions from so-called.
I'm sorry, Professor Howard?
Howarth, Howarth.
Thank you.
Apologies for speaking. So I summarize the results of that emissions analysis and also validate it with product information from the type of SMR that the company was going to use in phase 2. The result of that analysis is that on a per megajoule basis, so if you're trying to get the same amount of heating service, getting that heating service with gray hydrogen is going to be 40% more greenhouse gas intense than just getting it from methane itself, which is what that hydrogen is derived from.
Okay, so let me. Okay, and I understood that. I guess the question I want to ask you is: so, is there a pathway where they amend the project to the larger point? And I guess I've sort of just anecdotally read articles and seen pieces about the blending of natural gas and hydrogen as, lots of folks suggest this as a potential answer. I'm not saying it's a great idea or anything. You just see it referenced as a possibility. Is there a way that New Mexico Gas Company amends the plan that does satisfy your concerns?
So in my opinion, it's the gas industry who mainly thinks of blending hydrogen as an answer to its need to reduce emissions. people certainly in the environmental community, but also those who analyze how to meet greenhouse gas emission reduction goals at reasonable cost, don't think that hydrogen blending is going to be a viable strategy to get significant emissions reductions. And that's because you can only do so much, around 20% by volume, before you have to change out existing appliances. And 20% by volume ends up being around 6 or 7% by energy. So even if you assume that your hydrogen is, was not derived from fossil resources, has no carbon dioxide emissions associated with it in the process step, you're only looking at 6 to 7% emissions reductions. And basically what people think, hydrogen could be a viable strategy. Green hydrogen, zero emissions hydrogen, could be a strategy to reduce emissions, but it's best used in those sectors that are hardest to deal with electrification. And that's because you just have to go through a lot of conversion steps to get from renewable electricity to hydrogen, and you lose a lot of energy in the process.
So am I to understand then that, like, the provisions of the stipulation that say, the gas company can come back to the commission in the future and we'll have some hearing, or I can't remember the exact words in the stipulation, but that's more, I think more or less what it says. I mean, it sounds like if there's no path for an amendment of the project, I don't see what would be the purpose of some future hearing to determine something that you guys, I guess, are adamantly opposed to.
Well, I think the company can make an argument based on the based on the testimony and analysis, that based on the extra information they've learned from this process, the company may be able to modify its proposal. I still don't think it's going to end up being a cost-effective emissions reduction tool, but the company in the future can make that argument.
Okay, but I guess just for my purposes here, I mean, CCAE's position in this, as represented by yourself, is, effectively, I think you use the words, this blending of hydrogen is a dead end, and you very much mean that.
Yeah, and I say dead end because in the community of people who are really focused on how we're going to get to low levels of carbon dioxide emissions, a dead end pathway is a pathway where you have to make a lot of investments now, but you kind of are not able to achieve greenhouse gas emission reductions beyond a certain level. So here the ceiling appears to be 20% for hydrogen blending, and so it's almost like by definition a dead end pathway. You can't go beyond a certain point. That there could be dedicated hydrogen pipelines, but those too are going to run into challenges of, you're going to have to build a whole parallel system, and it might be better to use electricity and clean electricity to electrolyze and create hydrogen on site for those industries, for example, that don't have good electrification opportunities.
The paper you mentioned in your testimony, How Green is Blue Hydrogen, but that you've mentioned the authors' names earlier. Is this a paper for general consumption, or is this something that specialists only will sort of deduce something of value from?
I think anyone can get something of value from it if they're willing to, to give it some attention and sort of work through the same sort of engineering math that I do in my, I think, attachment 2.
Okay.
It's basically just engineering math, I thought it good to go through that paper, and also just to validate it with the BayoTech product specifications.
Okay, and then as to hearing examiner Hurst's questions about the rates, I guess my one question is, do you have any idea of the, I guess this may be the simply answer perhaps, the costs to ratepayers, I suppose you would say the cost to ratepayers that were avoided by sort of putting the brakes on the phase two. Was it, I mean, do you see that just only in terms of what was sort of, the brakes were put on, therefore they didn't, it was about $2 million, correct?
Yes, that's right.
Were there, I mean, do you see that the resistance offered as having additional benefits for ratepayers in terms of savings? Can you point to anything else?
Well, yes, this also delays or avoids the company pursuing a larger hydrogen blending project that would have had higher costs. Of course, they can come back, but I think this roadblock here, potentially stops some momentum there.
Okay, thank you very much, Mr. Sullivan. That's all the questions I have.
Thank you.
I actually have another question. Mr. Sullivan, as it relates to the agreements in paragraphs 21 through 25, and do you have any concern about enforcing those particular agreements to conduct certain analysis, to include certain items in a study, or to have participation in of others in gas company reviews of things?
I don't really have a concern about that. I think some of what we want the company to do on electric vehicles, for example, is add to and update its assessment of the availability of electric vehicle alternatives, sort of do update analysis that it is already doing, in the course of buying vehicles and in pursuing emissions reduction opportunities. So I think what we're asking them to do is kind of add to existing study processes and analytic processes.
Do you think cost should be a consideration when they're evaluating their vehicle replacements?
I do, and I think for light duty trucks, that electric trucks are going to turn out to be a cost competitive and likely cost beneficial option.
When?
Now, for if you're buying a Ford F-150 and you can get a Ford F-150 Lightning, it's likely to be a very competitive option.
What about with regard to the other types of vehicles that the F-250s and the F-350s that they've indicated were under consideration for purchase?
So my testimony, I mainly talked about the F-150, the light duty trucks that the company buys, a lot of. It's more difficult to make the numbers work at the current state of the market with larger vehicles. And that's just because, most of the costs of an electric vehicle are in the batteries, and you need a larger battery for a larger vehicle. But the market is changing very quickly. And so over the life of a new CNG vehicle, it's likely that electric vehicles are going to be a competitive option.
But did you hear the testimony earlier in the week when I asked gas company if they knew whether or not there was an EV alternative to the 250s and the 350s, and the answer was no.
And I'm also not saying that there's an alternative at the present moment, but I'm saying that they are coming.
Okay. But for purposes of this case now, your testimony is referring to the 150s.
Yes.
And then the other question on that topic, when you do talk about the batteries, do you have in your consideration any, well, the battery replacement costs?
No, I don't. Vehicles do warranty batteries, or sorry, manufacturers warranty batteries for a certain period of time. So I don't know how the length of that warranty is going to coincide with the number of years that the company is going to hold those vehicles.
Or do you think maybe that's not a consideration? If it's a short period of time, then they're not going to have to replace the battery.
My recollection is that manufacturers are warranting batteries for about 10 years. So I think it might not, I don't think that's likely to be an important consideration.
Okay. Thank you, sir.
You're welcome.
Ms. Lynch, any redirect for Mr. Sullivan?
No, ma'am, and we appreciate your questions.
Any questions from any party based upon my questions or hearing examiner Ryan's questions? Hearing none. Mr. Sullivan, thank you very much for your time. You are excused.
Thank you, hearing examiner Hurst.
Ms. Lynch, anything further from CCAE?
No, ma'am, thank you.
Thank you. I believe, according to the witness order, Mr. Gedko, you have a witness.
Yes, I do. The Office of the Attorney General would like to call Andrea Crane, and I see that she is in the process of connecting.
All right.
On my screen, it shows connecting to audio. So. There we
Good
go.
afternoon, Ms. Crane.
Good afternoon.
Long time no see.
I know. Seems like it was just a week or so ago.
Yeah, I think it was just a few weeks ago. Mr. Lee, would you please swear Ms. Crane in? And would you please raise your right hand? You solemnly swear the testimony you're about to give in the matter not pending should be the truth, the whole truth, and nothing but the truth, so help you God?
Yes, I do.
Go ahead, Mr. Getko.
Good afternoon, Ms. Crane. Can you please state and spell your name for the record?
Yes, I just realized my headphones were not plugged in. Can you hear me still adequately?
Yes.
Okay, great. Yes, my name is Andrea C. Crane, C-R-A-N-E.
And who do you work for and what are your duties?
I'm president of the Columbia Group. In this case, I was engaged by the New Mexico Attorney General to review the rate application of New Mexico Gas Company and to file testimony in support of the stipulation. Actually, I was hired to file testimony on revenue requirements, but as it turns out, the case was stipulated prior to that testimony being completed.
Do you have NMAG exhibit number 1, the direct testimony of Andrea Crane in support of the stipulation in front of you?
I do.
And do you recognize that as your testimony in support of the stipulation?
Yes.
And did you prepare it or direct its preparation?
Yes, I prepared it.
And are there any changes or corrections you would like to make at this time?
Yes, there is one change which I just correction, which I just became aware of actually while I was listening to Dr. Morin this morning. On page 11 of my testimony at line 18, I I refer to the NMAG concluded that the requested return on equity of 9.9%, that 9.9% should be 10.1%. The company's request in this filing was actually 10.1%. So if you could make that change on page 11, line 18 of NMAG exhibit number 1, I think that would clarify the record.
Hearing examiner Hurst,
Mr. Gecko?
should I make that change and re-upload to Dropbox that with that correction? Or will it be noted by everyone present and corrected in that manner?
Even though it's probably going to sound like a pain, it's probably better, Mr. Getka, if you actually do make the change and then upload it in the Dropbox. That will allow anyone who looks at that exhibit to know what the correct testimony of the witness was without actually comparing the transcript. All right. Any other changes, corrections, or deletions, Ms. Craig?
No.
Okay, but so Mr. Getko, if you know, if you could make that one change and then refile it in the Dropbox.
The link that you used previously, Mr. Gedko, should continue to operate because there was no deadline put on. You can create a timeline after which the link rots, but that link should remain effective as long as you have it. If you don't, it would be simple enough for you just to email me and let me know, and I can just send you the link. It's a pro forma task. Yeah.
Thank you for that. And shall I title it corrected?
Yeah, that'd be useful.
Okay, thank you. Okay. Taking into account that one correction, if I were to ask you the same questions today under oath, would you give the same answers as in your testimony?
Yes, I would.
And are these answers true and correct to the best of your belief?
Yes, they are.
Madam and Mr. Hearing Examiner, I request that NMAG Exhibit number 1 be admitted into the record.
New Mexico Attorney General Exhibit 1, Ms. Crane's testimony as verified and corrected by her here today in support of the stipulation, subject to the non-objection agreement of the parties, and as will be filed in the Dropbox pursuant to the order, I will provisionally admit subject to that entry, Mr. Gedko. Go ahead, sir.
Ms. Crane, do you have NMAG Exhibit number 2, testimony of Andrea Crane in response to the June 6, 2022 bench request in front of you?
Yes, I do.
And do you recognize that as your testimony in response to the June 6, 2022 bench request?
Yes, it is.
Did you prepare it or direct its preparation?
Yes, I prepared it.
And are there any changes or corrections you would like to make at this time?
No.
And if you were asked the same questions today under oath, would you give the same answers?
Yes, I would.
And are these answers true and correct to the best of your belief?
Yes, they are.
Madam and Mr. Hearing Examiner, I request that NMAG Exhibit number 2 be admitted into the record.
NMAG Exhibit 2, Ms. Crane's bench request as verified by her here today, subject to the no objection agreement of the parties. And Mr. Gedko, that in New Mexico Attorney General Exhibit 2 was in fact placed in the Dropbox
Yes, it was.
and subject to the Assistant Attorney General's verification that the correct version of the Exhibit 2 was entered into the Dropbox will be admitted. Mr. Gecko?
Thank you. The Office of the Attorney General tenders Miss Andrea Crane, for cross-examination or examination by the hearing examiners. Thank you.
Very well, thank you. Well, when last we spoke, Ms. Crane, I think you had 3 cases going on at the same time here at the commission. Are things settling down for you?
A little bit.
And I asked you last time about your chemistry degree and your navigation. Testimony proceeding. So I guess this time I would just say your testimony at page 3 and 4 regarding your qualification indicates that you've testified in over 400 regulatory proceedings. And I think it's kind of cool. We've had a couple of people, this is the first time that they've testified here, at least in New Mexico. And but we're happy to see you come back and testify and give us information. And it looks like to me the proceedings that you listed are approximately 19 states and the District of Columbia.
That sounds right. That sounds right.
Planning on trying to increase that number?
No, I'm planning to try and retire at some point. So I'm happy to see all these young people that are starting to come up and testify. I'm definitely not interested in increasing that number.
Okay. Now, this is subject to a bench request that I haven't gotten the answer to yet, but parties like to keep telling me about this typical or average customer. And you refer to that customer on page 7 of NMEG 1. Where you're recounting what the case is filed, and you're talking about a 9.1 increase in line 12 to the typical residential customer using 53 therms per month. That was your testimony?
Yes.
And in the stipulation, that typical or average residential customer using 53 therms would have a 4.3% increase, correct?
In this stipulation, yes.
Mm-hmm.
I don't know that I have that in here, but that's about right.
Okay. Oh, I've asked, since I've heard testimony from gas company that 90% of their customers base is residential or small commercial. Does that sound right to you?
It does.
I kind of would like to know where how many customers that 4.3 potentially applies to. Do you know?
I don't know, but I do know that in most cases, and probably in this case as well, a common discovery question asked by the rate design witness would be for the company to provide some sort of a usage distribution so that you could actually see the number of customers that take usage or, at any particular level. And that kind of a graph actually sounds to me like what you might be looking for. And that is the sort of data too that is relied upon usually by the company as well as cost of service, class cost of service experts in order to come up with whatever that usage is that is then typically plugged into the calculation of the average usage and the average rate impact. So I don't have that information. I'm not sure if Dr. Gigak requested that in this case or not, but my guess is that that information does exist, that usage distribution that would probably give you the information you're looking for.
Well, do you have an opinion on why they keep throwing that number out? Of what importance it is?
Well, I think it is very important actually, because even though I can't tell you exactly how it's calculated, I can't tell you exactly how many customers take exactly 53 therms per month. I can tell you that in broadly examining rate applications, whether they be the company's filings or stipulations or intervenor testimony, it's very common to try and provide an average for each rate class so that each party has a pretty good idea of what the rate impact is. Now, I doubt the rate impact is going to be exactly the same. Obviously, there's probably no average customer who actually takes the average, but it certainly provides you with meaningful information. I don't think that it's irrelevant because you do need some way to evaluate what the likely impact is on customers. And it might be 4.6%, it might be 4.5%, it might be 4.8%, but it's not 9.1%. And I think that's kind of the important point that we're trying to make here.
Okay. Well, since we're talking about ways to characterize the information, I mean, I guess I just think that, that percentages is put out by gas companies so they can say, hey, here's what we asked for, but here's, for this average customer that they refer to. I think it plays a lot better in public opinion when they're talking about a 4.3 as opposed to a 20.5. Don't you?
Yes, but I think there are two different issues going on. Okay, one issue is when you talk about the impact on base rates versus the impact on the overall bill. And that's when we talk about, for example, in the filing as filed, when we talked about, the 20.5% versus the 9.1%. And yes, the company does that because optically a 9.1% increase sounds a lot better than a 20.5% increase, even though they are both the same dollar increases. We're just looking at it in two different ways. One on base rates, which is frankly what we're here to talk about in a base rate case, and then the impact on the overall bill, which some customers really don't care and don't even know what a base rate is. They only open their bill and they want to know what the overall impact is. As a revenue requirement witness, I usually don't even get involved in something like what's the impact on a particular customer. I usually do it an even different way in that I will take a look at what they're asking for in total dollars. In this case, it was 40.7 million. And then I will compare that to what their total revenue is. Total revenue really from all sources. And that kind of gives me a rough percentage of what I'm dealing with regard to the overall revenue requirement. So I think I think one issue is, are we talking base rates or are we talking total bill impact? Now, a completely separate issue then is, how do you try and then determine the impact on any particular customer? And again, that's when there's really no other way to do it than to assume a certain usage level. I mean, you could go and you could actually see what the impact is for each customer at each usage level, but you'd have so much data that it really would no longer be meaningful to you. And so we're going to use a sum average, in this case 53 therms, and then you can look at that two ways. You can look at that based on base rates, and you can look at that based on overall bill.
Do you recall what the revenue requirement request was?
The $40.7 million increase, you mean in terms of what that was percentage wise?
What that was of the total revenue requirement request?
I have 20.8% above pro forma distribution revenue at present rates.
I'm sorry, I have how many percent
20.8%
above
pro forma distribution revenue at present rates is what I had in my analysis.
Do you recall if it was around 237?
Oh, you're talking about the overall revenue. I don't recall.
Okay, because you, in your explanation just now, you were telling me that that would be a comparison that you would look at the amount of the increase to the total amount of revenue at current rates, correct?
Yeah, I can. Yes, and I can do that math if you'll just give me 1 minute. Actually,
Okay.
in my notes, I had, as part of my analysis, this is not in my testimony, but this is the way I conducted my analysis. The base revenue increase was $40.74 million. And I say, or approximately 20.8%, assuming that was 20.8%, that would result in about $196 million of base revenue that was in the company's filing.
And then do you do a similar comparison with the stipulated amount?
I did not do that. I did not do that, but in this case, we did not in this case assume any change in billing determinants. So the 196 million would not have changed. Sometimes it gets really complicated because you're actually changing pro forma revenue at present rates for some reason, but in this case we didn't. So you'd still have the 196. And now if you're talking about, 19.3 divided by 196, that's 9.85.
68. But I think the overall increase was 9.68.
That there's probably a small amount of revenue that's included in the 196 that's not included in the 9.68, because then you also get involved in questions like, are you only talking about sales revenue, or are you adding miscellaneous service charges? And so that's probably why there's a little bit of a difference between the 9.8 I just calculated and the 9.6. Because there's something going on in there that's in one number and not in the other, but certainly those numbers are in the ballpark.
In your testimony on page 9, you're talking about that there were other consultants that you worked with in analyzing the application.
Yes.
At line 20, you're on page 9. You're referring to Dr. Woolridge and Dr. Gigax.
Yeah, I'm just hesitating a minute because, okay, I see them on that page as well. I was just making sure we were paginated the same. Yes, Dr. Woolridge and Dr. Gigax were both engaged to work on this filing as well.
Okay, but you're the only witness that filed the testimony?
That's correct.
Were they also involved in the negotiation, or was it just you?
Dr. Woolridge was not directly involved in the negotiation, although, you know, we had some discussions offline. Dr. Gigax was involved in it's my understanding he was involved in the negotiations when they got in, after we had agreed on a revenue requirement increase. I believe he was involved in the rate spread, the rate allocation, and rate design type issues that were left.
In your testimony on page 10, when you're answering the question posed at line 1 and 2, how does a future test year impact your review of a company's proposed revenue requirement? You testify at line 8, in the second part of that, most components of a future test year revenue requirement are speculative. That's your testimony?
Yes, it is.
And then you go on to say this is especially true for projected plant additions, which comprise a significant portion of the company's requested revenue increase in this case. Correct?
Yes.
Did you, were you listening? Did you just hear witness O'Donnell testify about the methodology of cost allocation on Maine, historical versus replacement?
I did, yes.
Do you have an opinion on which you think is appropriate?
Well, it was my understanding, and I'm not a rate design expert, so I could have been mistaken, but it was my understanding that he wasn't really talking about a historic versus a future test year.
Right.
I think what he was talking about was he was talking about more using like an embedded cost analysis versus trying to develop what it would take today to replicate the system at present dollars. That's kind of what I took away from his from his analysis. And with regard to that particular issue, you know, I don't have an opinion about whether the about which methodology is preferable from a class cost of service basis.
Okay. And I'm just trying to, I understood his testimony. At first, I thought he was talking about the test year, and then he clarified, no, he wasn't. And I thought, oh, okay. So he's talking about the methodology for, you know, for appropriately pricing the plant, and one being more accurate than the other. And then now I have you saying that the test year that's used, one is more accurate than the other, correct?
I'm just hesitating on the word accurate. One is more, in my view, one is certainly more complex than the other, and one is more speculative the further out from the base period we go. So, you know, obviously it's easier if you're going to do projections, it's easier to project what costs are going to be tomorrow than it is to project what costs are going to be 2 years down the road. And that's what I'm saying. It's much more difficult for all of us, the company, interveners, and I would think you and the commission as well, to evaluate something that's 1 or 2 years out. Because there are so many variables, you know, that come into play. So I recognize they have the right to file a future test year, however, in New Mexico. So I'm not saying that what they did was, you know, inaccurate. I'm just saying it makes it a much more difficult process when you have a future test year.
And I'm just wondering if there's a correlation between line 9 and line 14. So in line 9, you're talking about speculative. In line 14, you're talking about the revenue increase proposed as being excessive.
Mhm. Well, they're certainly related, but I would say that in all the cases that I've done, I'm usually recommending a revenue requirement increase that is less than the company is requesting. And so, and that's probably holds true regardless of whether there's a future test year, a historic test year, or in some cases, even a multi-year rate plan. So hopefully I'd be able to recommend some adjustments, even if a historic test year had been used. One good example is going back to the cost of capital. You know, it's very likely that the AG would have recommended a cost of capital on a return on equity that was lower than the 10.1% being requested by the company. And that would have probably been true regardless of the type of test year that was utilized. So they're related, but probably I would recommend something lower than the company in any case.
Do you agree with the assertion that was made today by I believe Dr. Moore, that the average return on equity for utilities right now is 9.5?
I haven't looked at that data. I have no reason to, question him. I'm sure he's looked at the data. So that doesn't sound unusual to me. I mean, there are awards that are lower than that, and there are awards that are higher than that. So 9.5 sounds reasonable.
Well, in terms of what you just testified to and what is in your testimony on page 10, that you had a disagreement about the proposed revenue increase, and when there's when the company comes in with a number, like in this case of we need a revenue increase of $40.7 million, and they settle for less than half of that at 19.3. And there's claims made about the revenue increase being excessive. How's the commission supposed to evaluate the excessive claim in terms of the stipulation?
Well, I think, I've been listening to your questions about the fact that the company has had so many cases stipulated and your concerns about that. And I think the premise of your concern is that the company took a lower number than they needed or than they may have gotten from the commission in order to get the stipulation. And I guess I think that premise does not necessarily hold true. I mean, if everyone does their job, if the company's done a good job advocating their position and the interveners have done a really good job reviewing the application, hopefully a stipulation will result in an outcome that is in line with what would have happened in a fully litigated case. So I don't believe that the company feels that they settled for something that was abnormally low. I mean, I'd like to think that I would like to think that I'm a really good negotiator and I was able to get a good deal for ratepayers, but the company has some really experienced negotiators too. And so we all sit in a room and we all feel like we we have an acceptable result. I mean, there are many cases in, there are cases in New Mexico, as you're well aware, where stipulations are presented to the commission and the commission actually changes those stipulations, in some cases, reducing rates even further. There are cases that are fully litigated in New Mexico where companies end up with an outcome that they feel is so unacceptable that they appeal that commission decision. So I don't think that you can kind of conclude that all stipulations will either, will either benefit one party or another. My own feeling is that one of the reasons we're seeing so many rate increases with New Mexico Gas Company, it may have more to do with who their new owners are than anything else. I mean, I guess it was around 2014, they were acquired by TECO, and then 2015, Emera. Before that, I think 2011 had been their last case before the acquisition. And so it may be, it may be management, frankly, that has taken the position or the policy that a rate case, every couple of years is the new normal. And that wouldn't surprise me, because it seems to me, and this is anecdotal, but it seems to me that a lot of companies are filing more frequently than they did in the past.
And, and I don't mean to give the impression that I don't think stipulations are necessarily bad things. I mean, stipulations, are encouraged by the commission. I think they can be efficient. I think they can result in less costs, although I don't think that's happening in this case. From the testimony I've heard, they keep telling me the rate cases are not going to decrease, even though it was stipulated and not litigated. So I guess, Ms. Greenwood, the difficulty that I'm having trouble understanding is twofold with regard to the revenue requirements and stipulation. And one of them, as you might surmise, was the fact that there's 3 rate cases in 4 years. It's approximately $26 million revenue increase stipulated among the 3 cases. And they're going to file again in the end of 2023. And I'm just wondering if it might have been better to just have one rate case and actually have it litigated, rather than go to the time and expense for all 3 of these to potentially reach a same result. Do you have an opinion on that?
I do have an opinion, and it's just an opinion. My opinion is that the company probably will file again for a rate change about 2 years after this one is effective, or file at the end of 23 for a rate change in 25. And they probably would do that regardless of whether we fully litigated this case or whether we stipulated it. I don't believe that I don't believe that the company would have, well, let me just put it this way. The stipulation does not include a rate stay out, right? I mean, if it does not, right? So sometimes companies will say, if you give me more money, I'll agree to stay out. Okay. Well, we don't see that here in the stipulation. So my guess, and it's really only a guess, is that they were going to pretty much file whenever they're going to file, regardless of whether the prior case was stipulated or litigated.
But for efficiency purposes, if you need $30 million revenue requirement, I mean, isn't it more efficient and more cost effective to do one case to get that $30 million than it is to do 3 to get 26?
Well, I guess the company, I'm speculating, but I'm guessing the company felt that it maybe couldn't justify, its original request.
Okay.
And we certainly didn't think they could justify their original request. Their projected plan additions, and this goes back to the discussion of the future test year, their projected plan additions were significantly higher than actual plan additions that have been completed in the past few years. And we certainly took that into account in our analysis.
Well, and I see that your testimony on page 11, you know, lines 1 through 3, you say that. And I'm just wondering if you have an opinion as to why that is. Why they made that proposal.
In terms of having so much more planned,
yes.
Yeah, I for a couple of reasons. One is, let me say, this is not unique to the gas company. I mean, we're seeing this all across the country. But I think we are, realistically, you probably are dealing with some aged infrastructure that probably does need to be replaced. That's an issue. That's a problem. Number two, and you can basically go to any utility company and look at their presentations to investors, and they are telling investors that we're going to increase your earnings by increasing rate base. That is the way that they are going to make, that they're going to increase their earnings per share. And every utility is now sort of giving that same presentation. And so I'm not surprised that New Mexico Gas Company is giving that presentation. And that presentation is even easier to sell if you have a future test year, because as I say, no one really knows until after the fact what's going to happen. So it makes it easier with the future test year for the company to frankly be as optimistic about its future plant additions as possible, because that's the way they grow their earnings.
Okay. Well, you indicated that you did agree that they, probably had plants that needed to be replaced. Do you believe that the amount of the proposed plant addition is indicative of a state of disrepair?
We included in our analysis, when I ran numbers for the AG, I included significant reductions from the plant and service additions that the company is proposing. Number one. Number two is, I don't know if disrepair is necessarily the right word, but I'm sure that there is infrastructure that for safety reasons and reliability reasons, technological reasons, probably needs to be replaced. And they've actually started, and they've actually, completed a good portion of that replacement for certain sections of their infrastructure and certain types of pipes. So they're well on their way. And I think they would, I think they know that they have to do that, and I think they're going to do that. And I think they can do that safely, even with a lower revenue requirement than they had requested in this case.
And I'm just, I'm just wondering if you thought that the significant amount of plant addition that they were requesting was a signal that the system's falling apart and they had to, throw, this excessive amount of or as you say, significantly more plant than historic levels would indicate.
Yeah, I don't think so. I don't think it's a big safety issue. I
Okay.
think it's, yeah.
Okay, well, let me just further on down that page. It seemed as if another issue that you had that you testified to at line 8 on page 11, over 80% of the remaining increase was related to labor. Including significant base salary increases, more generous incentive compensation plans, and substantial increases in the number of employees. Now that the number of employees are gone, how comfortable are you with the labor increases, including the recent additional 4% for the retention of employees that were quitting?
But I'm comfortable with the overall results of the stipulation. I know there's been testimony by the company as to how it got to the components of its cost, the cost of service that was provided, the line by line cost of service that was provided in the stipulation. They've told you that how they got there, and they were the ones that prepared it, and that included certainly delay of these 32 additional employees. And that's fine. I would just indicate that once we agree on a revenue requirement, the company really can use that revenue increase in any way that it chooses. Okay, so when they get their $19.3 million, if they see that there's, if the labor market opens up and they can fill those positions and they feel that that is the top priority over something else in their revenue requirement, they can do that. They're not wedded, frankly, to the uses that they have that are contained in the stipulation, because we're not going to go back and we're not going to go line by line to make sure that each of those dollars was actually spent in the way that it's outlined in the stipulation. We give them a bucket of dollars, and then they will, over the next couple of years, decide what their greatest needs are. Having said that, I do think there is a problem, obviously, with employees and employment in that area. Certainly, if you can't fill the positions that you have, the vacancies that you have, it probably doesn't make sense to start trying to bring on 32 additional positions if I can't even fill the positions that I have. And I will tell you again that in our analysis, I did recommend to the AG significant reductions, both in the number of employees that they proposed to bring online, as well as I felt that perhaps the 5% increase that they proposed for 2023 was a bit excessive. So we had some deep cuts in our analysis with regard to the labor costs.
Well, if you thought 5% was excessive, what do you think about 9%?
The fact of the matter is, I'm not close enough to that particular market, to know. But the company obviously believes that if they have sufficient dollars through this stipulation, that if they need a 9% increase for a certain core group of employees, that they have the dollars that will enable them to do that. And that's fine. That's where their management discretion, in my view, comes into play. That might mean that they have to take smaller bonuses for their executives one year, or it might mean that their shareholders have to shave a couple pennies off their return, or it might mean that a specific project gets delayed. But they're the ones who, now that we have agreed on a total pot of dollars, they're in the best position to really know over the next 2 years how to use those dollars efficiently.
Okay.
Can we take a break soon?
Yes, sir. Can I ask one more question?
Certainly.
Down at the bottom of that page, you're answering the question about cap structure and cost of equity. You say at
Yes.
lines 19 through 20, these factors also contributed to our finding that a revenue increase of significantly less than 40.7 was appropriate in the case. If that's your testimony?
Yes.
What were you thinking was a good number, Ms. Crane?
Well, I was thinking of about a number that was in the ballpark, but a little bit lower than where we've settled. I was thinking of a number, however, that also had a lower ROE than the one that we settled on. And if you took my recommendation and you adjusted it for the ROE and cap structure that we settled on in the stipulation, that was extremely close to the number that I had given the AG as a potential number to resolve the case. So I felt fairly comfortable, very comfortable actually, with where we ended up. Now the kind of the big unknown that kind of got dropped on us at the last minute was what's called the fourth errata, where then they came through and they said, well, we're going to have, $3.2 million of $3.3 million of increased revenue that we hadn't anticipated, but we're going to use 2.4 of that almost in order to beef up our salary, our salary offers and packages. And frankly, they were numbers that I had not factored in to my original analysis. So I thought about, what do I do with those? And frankly, I felt that the number that we had arrived at reflected so many of my adjustments that I felt if we litigated, there'd probably be some litigation risk. And, I probably would have used up that net $940,000 somewhere on losing some of my other adjustments. And that's the way I kind of thought about the entire settlement. So I don't know. I hope that's helpful.
Yes. Thank you. We are going to take a 10-minute recess. At this point, I have 3:22. So let's come back at 3:32. So we'll take a 10-minute recess. How are we doing, Mr. Lee?
Good.
Good. Okay, let's go back on the record. And before we continue with some more questions for Ms. Crane, I just wanted to update the parties, and especially you, Mr. Gould. I think, based upon my conversation with hearing examiner Ryan, and because we are pleased with the pace of the 3 days. If you could let Mr. Gorman know, we will begin with him tomorrow at 9. And Ms. Crane will be our last witness for today.
Thank you so much, Madam Hearing Examiner. He is listening on YouTube. And
Okay.
just texted me and asked if he didn't know if you were done with Andrea or not. He thought maybe.
Oh, no.
But yeah, I told him, hold your horses, dude.
No, we have
this
a
is-
few more questions.
This is going on for a bit, so but I will text him and make sure he understands that. So we will have him on at first thing in the morning.
Very well.
Thank you.
Thank you.
And I've not been using my video because I seem to have a little bit instability in my internet connection in the afternoons for some reason. I'm not sure why, but I am attending. So, but I'm going to call Mr. Gorman right now.
Very well. And Mr. Dome, if I could just refine my bench request number 1, that was to Mr. Shell, and I wanted some kind of representation of the average number of those residential customers that were typical, and now I have a name for how that is represented from Ms. Crane. So, Mr. Domick, if gas company has a usage distribution graph that will show me that the customer information, I would like bench request number 1 to include that.
Madam Hearing Examiner, I'm looking at our draft, and that's exactly what we've got drafted up for you.
Awesome. Thank you very much. Thank
You're
you,
welcome.
Ms. Crane.
You're welcome.
It's always good to be able to put a name.
Miss Crane called me and told me that that's what you would be wanting, so I jumped on that right away.
Oh, excellent. Excellent. Yeah, you all know I like to name everything. The vehicle has a name, pretty much everything has a name. Now that I'm being funny, now I close my notebook. Not good. Okay, let's open that back up. Okay, so we were talking about what would be a good number, and you told me how you arrived at a good number, but you just didn't volunteer what you thought that good number would be, except that it was around the number you agreed to, correct?
That's correct.
But then there was a wrinkle with the labor situation fortuitously being accommodated by the transportation contract, resulting in an approximate $900,000 revenue decrease, correct?
Well, it was a revenue increase, a revenue requirement decrease. So it actually benefited customers.
Yeah, and I misspoke. It would result in a $900,000 revenue decrease.
I could have
Correct.
gone lower by $900,000, basically.
So it's like buying something on sale and then it goes on further sale.
Well, yeah, but there was a little bit more uncertainty in a rate case than there is in buying something on sale. So I had to kind of then factor in which, if any, of my issues I might actually lose if we litigated. So that had something to do with my decision making there.
Okay. Very, very well.
So I think all my adjustments are great, but usually the commission finds something that they don't like. So I just wanted to, I wanted to put something in there to recognize that.
Only if it results in retroactive rate making. I wanted to ask you one more question on page 11. And it also, again, has to do with that 50%, your lines 8 through 13. And what I interpreted to be that you thought that the labor and benefits was high. Is that correct?
Yes.
How would you say that the salary and compensation plans for gas company compare to other utilities or other gas companies that you're familiar with?
Well, of course, when you're talking about salaries and wages, it's very sensitive to geography. So I think that, in some cases, in places that might be higher cost locations, utility workers may actually, and this is a very general statement, may have higher levels of salaries and wages than they do in New Mexico. I think overall, while executive salaries look very high, they're not as high as they are in some places. So overall, I think that I don't think the gas company has traditionally overpaid its employees. In this case, they were proposing a further increase in incentive comp. I think they were going from 6 to 10% on the incentive compensation plan. That seems high to me. That 10% is sort of a high number. And that's just the percentage that would be of incentive. That's the percentage of incentive comp as a percentage of base salary. And I believe that they were increasing it from 6 to 10%. That has nothing to do with the further, 5% and then 4% in terms of base salary adjustments. So I was a little concerned about that. As I think you heard yesterday, they were not asking for their long-term incentive compensation to be paid for by ratepayers. And I was happy to see that they were not requesting recovery of that long-term incentive comp. So that was a good thing. But yeah, so I think they're kind of my thoughts with regard to labor.
Well, it just putting it in terms of, because you testify here in New Mexico in other rate cases, don't you?
I do.
And in primarily electric rate cases, correct?
Yes, because gas companies kind of the only big gas company in New Mexico.
Yes, but my point is that you're familiar with compensation for other, since you're referred to geography, you're familiar with compensations and salaries in other New Mexico utilities, aren't you?
Yes, generally speaking, I am.
And do you find gas companies to be in line with what you know of the other public utilities here in New Mexico?
I do.
Oh, do you? And I don't know if you were listening yesterday or not. Were you listening when I was asking some questions of the Vice President of Finance gas company witness Blotter?
I'm not sure that I heard all of her cross-examination, but I heard some of it.
Okay, examination, not
Or
cross-examination.
examination. Sorry, excuse me.
Not a
Examination.
party. I don't know, that's fine. But one of the kind of unique things, I believe, in looking at gas company is its shared service. Do you find that kind of unique among New Mexico utilities or no?
Well, certainly SPS has, a similar type of arrangement. PNM doesn't really have a similar type of arrangement now, but it may at some point in the future. So I am familiar with generally with SPS and their kind of corporate structure. And I will say that I think outside of New Mexico, it's pretty common also for there to be a shared services company that, provides services to various utilities.
I just wonder, do you use a different lens or a different philosophy when you're analyzing the costs and the expenses? If it is a direct cost versus a shared cost?
No, I wouldn't say that we use different lens. I would say it's a much more difficult analysis when you have a shared services company. It's much harder to get behind the numbers, when you're dealing with a multi-level organization, when you're dealing with allocations that might come from shared services as well as corporate. And sometimes there are even other affiliates that are allocating costs. So it's more difficult the more subsidiaries or entities there are that are allocating costs to the utility. Your goal always is to make sure that the costs that end up at the utility are just and reasonable, and that the services that are being provided are necessary for the utility, and that the utility is not subsidizing other affiliates. So you try and be as you try and have a review that's as strenuous as when you don't have affiliates, but it's much more difficult when there are affiliate relationships involved.
And I realize that you might have had assistance analyzing this, but you're the witness, so I'm going to ask you. Did you have any concerns with the composition of the debt equity imputation?
I'm sorry, debt equity amputation?
Imputation?
Thank you.
You mean in terms of the capital structure that was being proposed here? It's obviously I wasn't the primary witness on that, but it's my understanding that the actual capital structure of Gas Company of New Mexico is very heavily weighted towards equity, and therefore it would probably be unreasonable to use their actual capital structure, and that's why sort of an imputed capital structure was being proposed here. I think we did obviously have some concerns about the 53% and felt that was too high, and that's why we kind of ended up at the 52% rather than the 53% that the company had proposed. But you want to make sure that the capital structure is appropriate, and especially for a utility that is owned by a parent company, because in a way, when you have a utility that has this corporate structure, the actual capital structure is kind of artificial because the parent company can pump equity in and basically take equity out at, more or less at will. I mean, there are obviously guidelines, but more or less they can kind of dictate what the capital structure is. And it would not be appropriate for ratepayers to pay rates that reflected a very high equity ratio simply because the parent company decided that it was going to pump up equity in a utility company that they owned. And so in these cases, it's very appropriate to look at hypothetical or imputed capital structures.
Do you think that, I mean, is there a way that they could ever get out from under the actual structure?
I don't think so, unless they spun themselves off somehow or other. I mean, as long as they're owned by another corporate entity, that corporate entity is going to basically dictate the capital structure. Now, what the commission can do, and they probably even have it here, I don't recall, but in most merger cases, there's a condition imposed that at least the equity ratio will either be held within certain certain benchmarks, or that the equity ratio will not fall below a certain amount. And that's because we kind of are also concerned about the flip side of the coin. That is a parent company that comes in and takes out all the equity, and that's not good either. That's not the situation. I don't believe that was at issue in this case. But I think as long as they're owned by Emera, TECO, and then Emera, there isn't really any way short of spinning them off that you're going to avoid that relationship.
Well, and I thought part of the issue was that huge goodwill adjustment.
Well, that's actually a different. Yes, that's actually a different issue, related issue. I mean, one of the reasons it's so high is because there's so much goodwill. And as you may recall, during the acquisition cases, because generally companies that buy utilities pay a premium, okay? That premium, or a good portion of it at least, is generally booked toward as goodwill. If that were considered to be plain old equity for the rate making process, then ratepayers would be paying a huge amount in rates based on the decision of some company to pay a premium for the utility. And that's, that's not right either, because that really is somewhat a subjective decision as to what the purchaser is willing to pay for the utility. In this case, I remember too, we were also concerned not only did we not want to pay to include the goodwill in equity from a capital structure perspective, but there was also an issue of anytime there's an allocation, we wanted to make sure that that goodwill equity was not used to assign more costs to the gas utility. So there are a couple of adjustments in the rate making process to kind of make sure that that goodwill does not enter into the rate making equation at all. Having said that, though, you can have capital structures that are out of whack or that are too heavy with equity, even without having goodwill. But in this case, the goodwill is causing that heavy equity. I believe.
And as far as the goodwill is concerned, does it just stay there forever?
Yeah, it basically stays forever until unless there's a reason why the company believes that it will not be able to recover that goodwill. So basically, as long as it's staying on the balance sheet, and I don't remember the specific accounting rules or classifications, but in essence, once you book goodwill, it stays on your balance sheet, provided that you are that it still has value and that you have a reasonable expectation of basically, being able to earn a return and recover that goodwill essentially over time through your entire business enterprise. Let's say that something happened though to Emera and for whatever reason, the company was going to go bankrupt or it had some tragedy happen to it and all of its assets were somehow in jeopardy. In that case, the accounting rules require that there be a write down of goodwill. And so that would be one way, or write off basically of goodwill. And so that would be one way that you would actually reduce the level of goodwill on your balance sheet.
Okay, otherwise it's just gonna stay there until and unless if the parent company ever tried to sell gas company.
Yeah, it's going to stay there.
Okay. All right, thank you. I appreciate that. Oh, further on in your testimony, you are on page 15, you're testifying about Dr. Woolridge analysis.
Yes.
This was something that was done but not filed, correct?
Yes.
And you're saying it was lower than the 9.375 that was agreed to?
Yes.
But apparently I guess what, in the spirit of negotiations?
Yes.
You went up on what you would accept?
We did. And it's no surprise we're in a little bit of an uncertain time here. I guess we're not quite sure exactly what's going to happen with interest rates, the economy, inflation. I mean, there is some uncertainty. And I think for that reason, the parties all sort of felt that kind of keeping the current capital structure and cost of equity was one way that you could, satisfy everyone or satisfy no one, but something that we could all live with.
Okay. And then further on down, you're testifying as to what stipulation will result in just and reasonable rates. And you get into your testimony of what I asked you about earlier about the 4.3 typical residential customer using 53 therms is going to pay about $2.67 more a month for this part of their bill, correct?
Yes.
And then further, line 16 and 17, you get into that comparison I also asked you about earlier, about the revenue increase to the residential class being slightly less than the system average increase. Correct?
Yes. Yes.
And which you say is consistent with the recommendation of Dr. Gigax. That recommendation also wasn't filed, was it?
No, it was not. You're right.
Do you know what what the range was that he thought was appropriate?
I don't know exactly what it was, but it wasn't a lot less than the system average. Of course, when he was doing his numbers, initially, we didn't even know really what the revenue requirement was going to look like. So he was just saying, assuming a revenue requirement of X, how would you distribute that? So he was lower, but I mean, it was, my recollection is it would have been like less than a whole percentage point, if it wasn't significantly less. He was recommending residential allocation that was a little bit less, but not significantly less than the system average.
Okay. Further in page 16 of your testimony, you're talking about additional benefits. And Is there any concern on your part that not addressing some of the issues like the IMP rider mechanism just delays an issue that should just be dealt with and get it over with?
Well, in this case, at least the company agreed not to file for an IMP rider in its next base rate case. So from my perspective, we have a little bit of a breather on that issue that, we seem to see every year or two. I'm not concerned.
Sorry, did you say foreign IMP rider?
For FORNAN IMP rider.
Thank you.
Sure. So now I really don't, there was no indication, let me put it that way. There's no indication in this case that the company would have agreed to a stay out if it had gotten an IMP rider, right? That wasn't part of their proposal. They didn't say in their testimony, if you give us the IMP, we'll stay out for 4 years. They didn't say that. And so I don't think the lack of an IMP rider is problematic, especially if they are going to file anyway in 2 years, because you're not talking about them foregoing these returns over a long period of time. And in fact, they get the deferral, they get the regulatory asset. And then there is sort of one carrot and stick in the stipulation, in that in order to get recovery of that regulatory asset, they have to basically not change rates prior to January 1st of 2025. The company could come in and file another base rate case immediately after a commission decision in this case, but if they do so, they'll be precluded from getting recovery of that regulatory asset. I'm on record as being against the IMP. I have been for years. I think that the company will be perfectly fine without it.
And that's one of the sort of the things that I was trying to understand, because it seemed like to me that if, at least in the last 2 cases, and I can't remember if even it was the 3rd case, that they've come in here and it's sort of like, if it looks like a duck and quacks like a duck, it's a duck. And it sort of seems like to me that this is plant that goes in base rates. That, so why are they trying to get it through a rider?
They're trying to get it through a rider so that they can get contemporaneous recovery of this, so that when it goes in, they'll be able to start charging ratepayers through a rider for this plant. And they're doing that because it increases their earnings. That's the bottom line.
But if they're filing rate cases every 2 years, isn't that pretty contemporaneous recovery?
In my opinion, it is. And that's why I say, we might be having a different conversation if the company had come in and said, okay, give me an IMP and I promise you won't see me for 5 years in a base rate case. But that's not the conversation that we had.
Right. And so, see, you just come back to my, to my, to my inquiry of how can it be efficient or cost effective to have 3 rate cases in 4 years just on, I mean, just when you consider rate case expenses? Did you look at rate case expenses?
I did.
Did you have any issue with rate case expenses in the past three rate cases?
Well, what I looked at their proposed rate case expenses versus their actual rate case expenses in the last 3 cases. And frankly, I probably would not have recommended an adjustment to the dollar amount, but I probably would have recommended an adjustment to the amortization period. They were seeking a 2-year amortization period, and if I had filed testimony, I probably would have simply recommended a longer amortization period with no carrying costs, which means that essentially if the company came in before the end of that amortization period, they'd have to eat any unrecovered rate case costs.
33 years, like they propose in the ADIT?
No, 3 years. I know it's longer, like 3 years, not like 33 years. Yeah, 33 years is a long time.
You know, and I think it's been a number of years since you and I discussed ADIT. I think I still have a headache.
Me too.
I'm sure, for me not understanding it, but from what I recall from all those years ago, that's why I was asking I don't know if you heard, I was asking the questions about 33 years.
I did.
Seems like a long time to me, but okay. I have one more question, but I can't think of it right now. So I thank you, Ms. Craig. And I believe that hearing examiner Ryan has some questions for you.
Okay,
Yes.
Thank you. Thank you, Madam Hearing Examiner.
Perfect. Thank you, Ms. Crane. I'll just pick up where Ms. Hurst left off, actually, and just that question about the rate case expenses. So I'm sharing here, this was Leslie J. Nash, exhibit LJN 7, admitted through, I believe it was Mr. Jones, who appeared as Ms. Nash is out on maternity leave. In any case, these are the rate case expenses. And so, I mean, one question I brought up, and it struck me as a significant sum of money, this Yardley Associates, $225,000, you can see there. Is that what one can expect in a FACOS rate design expert? I mean, is that a typical charge?
Well, Mr. Yardley, I've known him a long time. He's a very good consultant. I will say that. I think it's not only the class cost of service rate design testimony, but also the IMP testimony, I think is embedded in there, because you don't have a separate, and I'm sorry, my eyesight is not that great, but I don't think there's a separate line item. So that's for, thank you so much. So
No problem.
that's basically for both of those topics. You know, it's a healthy amount of money for Mr. Yardley, but he is very good at what he does, and you know, I don't know what else to say about that.
Does he have is it just Mr. Yardley behind a computer furiously, or does he have like a team of people that he's, I mean, it's one thing if it's just one guy, but if it's a whole, 10-person operation, and then you're employing a lot of people. Do you know?
I don't know. And I as I said, I've known Mr. Yardley probably for 20 years, and I actually don't know. I have only dealt with him, so I don't know if he has a lot of people who work for him or not. My feeling is that, he certainly does the majority of the work himself, if not all, but I don't really know what his setup is.
You mentioned earlier, or just when you were speaking to me about what his work would entail, and you said the IMP is part of this. I mean, the only issue is, of course, you and Ms. Hurst had discussed there that the IMP keeps coming up. One of the things Ms. Hurst was saying, which I thought she was going to conclude, was to suggest that, perhaps the IMP is some sort of mechanism in a, negotiation. It's a thing that they can utilize to sort of use as a placeholder and say, well, we have this thing, but we'll pull it away because we've done that now in several cases. And I guess I'm wondering with Mr. Yardley, well, if you have to do that testimony, but it's all going to get taken off the table, what was that worth?
Right. Well, yeah, we call those throwaway issues here.
Okay.
And it may be. The other consideration is that Mr. Yardley put in similar testimony in other cases, so he probably wasn't starting from scratch in this case. But having said that, though, I mean, I do think it's important to keep in mind that once we agree on an overall revenue requirement, as I indicated, the company can pretty much spend that, however it sees fit. So this was their budget. I don't know if Mr. Yardley will actually get the amount of money that's shown on this page. I don't know what their actual rate case costs will be.
Right.
Frequently we work, consultants work on like an hourly basis, sometimes with a not to exceed cap.
Okay.
If there's a stipulation and then, you may not reach that cap. So I'm not sure what the specific arrangement is for Mr. Yardley.
And then for Dr. Morin, obviously the gentleman, I mean, from his resume, and has achieved a great deal in his life in terms of this subject matter. But so that number of $80,000 is that within a ballpark range that you would expect?
Yes, I would expect that.
Okay. I mean, I guess without going through all the rest of these numbers, was there anything in here that jumped out at you like, wow, that's a lot? I mean, the layperson looks at this and they have whatever reaction they're going to have, but that's not a reaction of an informed person. So that's why I'm asking you.
Well, since I'm a consultant, I think the outside counsel is always too high, frankly, as opposed to the consultants. But that does always kind of jump out at me, the outside counsel. And again, I mean, things in here like travel, meals, and lodging, $60,000. I wouldn't expect that to be as high as they had projected, just because of the situation that we're in and we're not traveling. So, I mean, overall, though, if you look at their actual costs in the past couple of cases, in the last case, it was 2.8 million. So when you look at that 2.8 million and then look at this 1.6, I mean, this almost looks like a bargain. In the 18 case, it was just under $1 million in rate case costs.
Ms. Crane, if I could just ask
go
you,
ahead.
That's kind of my point is how much did you just say the rate case expenses were in the 18 case?
They're actual, and I don't know now I don't know how these compare with what the amount of the projections were in their cases, but their actuals in the 18 case, it was just under $1 million.
And parties stipulated in that case for a $2.5 million revenue increase, didn't they?
They did.
So almost half of not quite half, but a significant amount of what the revenue increase in that case went to rate case expenses, didn't it?
It did. I think that was the case where they where they included a transmission line. There was one case, and I think it was that 18 case, where they had a very, very large plant addition coming online, like a gas transmission main or something. And it was really driving that entire case. I'm pretty sure it was the 18 case. And
what about 19? How much were the revenue or the rate case expenses in that case?
2.8 million.
And the party stipulated to a $4.5 million revenue increase. So again, almost half of the revenue increase went to the rate case expenses, didn't it?
It did. But I mean, the reason, in fairness, the reason that if it was the 18 case, and I think it was, the reason that we settled on an amount which was so much lower than what they asked for, was because they pulled out a huge transmission project, which was really driving that whole rate case. So and that was not a future test year case. So once they missed that deadline, that whole case kind of just fell apart.
Could it also have had to do, I had an explanation earlier about something to do with the tax change, something.
Well, the tax cut and Jobs Act.
Yes.
Yeah, well, yes, that certainly also probably, had some impact because there were huge reductions in federal income taxes. So I don't know exactly when that case was filed versus when that tax cut went into effect. But yeah, that would have been reflected as an offset basically to cost increases, would be those tax savings.
Okay, thank you. Thank you, Hearing Examiner Ryan.
Oh, no problem. That's very good. As we're sort of focused on these macro issues, I did ask Dr. Morin a question, and this relates to the return on equity. And there's some dialogue about this in the responses to the bench requests. And I just wanted to ask if you have a perspective on the subject, which is, this question about electrification and the future of the gas industry and the extent to which that gets built into the market itself, and the stock prices. I mean, how fast that's absorbed, and to what extent should that bear on the return on equity in this case? Do you have any feelings about that or opinion?
Yeah, I don't. I mean, it is a real concern because I'm starting to see in a lot of cases that I'm in, there are interveners that are trying to stop all gas extensions and that sort of thing. So I think it's definitely a concern. I'm not sure where the future of the gas industry is going. On the other hand, if storage doesn't happen as we hope it will on the electric side, and you have to use gas as an alternative fuel because your renewables aren't producing at the proper hours, I mean, gas may have a better future than the one that we're imagining. So I don't have a crystal ball. I do think that in this case, we're talking about a company that is associated with other utility companies as well. So I think that if you're looking at Wall Street, I mean, Wall Street is probably not as concerned about what is going to happen to New Mexico Gas Company as it might be with regard to a standalone gas company where, they were buying stock in a standalone gas company, and that was really the only business that was being conducted. I mean, that's not the case that we're dealing with here, but the extent to which investors have actually factored the future of the gas industry into their decision making, I can't really answer that, and it probably varies depending on the individual investor.
In Mr. Yardley's initial suggested increases as a consequence of his cost of service, he came up with effectively three numbers. There was a category of 26%, a 20.5%, and then 0. Is that normal to see just three chunks, three groups?
No, I don't necessarily think it's normal, and but I do think there was some discussion about why it probably happened in this case. I mean, the company presumably, and I have to admit, I'm not as on top of the class cost of service numbers as I am the revenue requirement numbers, but it's my understanding that if you actually set rates based on the actual results of his fully allocated cost of service study, you would have had some classes that had extremely high increases, and that in order to mitigate those increases, they decided to cap those, and that's why you came out with that 26%. That 26% maximum, basically, and that's why so many categories were at 26%, because presumably they all would have been higher, which actually is not surprising either, because we know that this is a very heavily oriented a utility that's heavily oriented towards the residential customers. And what happens is there just sometimes aren't enough billing determinants or customers in those other classes to move the mark. So when you start to try and spread a revenue increase, there aren't a lot of places to put it. And that's why sometimes you can get really high numbers resulting. With regard to the zero, I'm not sure why that would be, but I have frequently seen that in cases where you have a class that would otherwise you would reduce their rates if their rates are above their cost of service and the class cost of service indicates that a rate reduction might be appropriate. Some companies feel that if you're going to, especially with a 20% average increase, if you're going to increase some people, by 20%, that you should not decrease any other class. So sometimes they just hold that at zero, and even though that class might qualify for reduction, they'll say, you know what, we're just going to keep it at zero. And so their rates will just stay the same.
Okay, thank you. I had similar questions about Dr. Woolridge and Dr. Gigax. I certainly know who Dr. Gigax is. I don't know who Dr. Woolridge is. Who is that individual?
It's Dr. He uses the first initial J period, Randall Woolridge.
Okay.
He's been a professor at Penn State University for, I've known him for probably 30 years. So, and he was a professor at Penn State when I met him doing consulting, actually, the same thing that he's doing now. He's you can Google him, and he has quite an impressive resume as well.
Then if you could just sort of respond generally, just for the record, in the event that I'm asked, by the committee, what did they do? What was Gigax here for? So what was their function in terms of the analysis they performed for you, which then led to this testimony we have today?
Sure. Dr. Woolridge does cost of capital. Okay, so his tasks would be look at the capital structure, look at the cost of equity, and to some extent look at the cost of debt. That's usually not controversial, but so he's the cost of capital expert. Dr. Geek, then I'm the revenue requirement person. So then I take Dr. Woolridge's recommendations. I run that through the revenue requirement model with the revenue requirement adjustments.
I'm sorry,
and I come up with.
Can you slow down a little bit?
Sure. Sorry. I am the revenue requirement person. So I take Dr. Woolridge's recommendations and I run that through my revenue requirement model with my adjustments. And then I determine what the total dollar amount should be of any rate change, increase or decrease. So I came up with the total dollar amount that I felt the company had justified for an increase. Then I give my number to Dr. Gigax, and he takes that number and he allocates it among the various customer classes, number one, and then within primarily the AG is concerned with residential and small commercial. So they're the two classes. Once he allocates the dollars to the residential and the small commercial, he will then make a recommendation on rate design, which is basically how much do you get from the fixed access charge that you charge each month versus how much do you get from volumetric charges. So that's his tasks.
And that's basically what they performed for you in this case as well?
Yes.
Okay. This is sort of a non sequitur, but just out of curiosity, you went to Temple at one point?
I did.
Did you grow up in that area?
I did. Did you?
Did you grow up in Yardley?
No, I'm a Philly girl.
You're from Philly.
So yeah, I grew up in the Logan section of Philadelphia, right inside the city.
I could tell from your accent, and I was trying to figure out what specific pocket of the Pennsylvania, New Jersey area. Cherry Hill is its own thing, and my friends from Yardley, you've said some words, and I swear to God, it's like my neighbor at home. It's like listening to her. So
that's right. I've been trying to get rid of that accent for a long time.
No, keep it. It's very good. And as to the point of Mr. Lee, it's what allows you to speak at the pace you do. You learn how to clip the edges of words so that you can just go. That's what we do back on the East Coast. So it's been hard to unlearn that. you refer to, and Ms. Hurst asked you about this at some length. You say at page 10, most components of your it's not necessary that you follow along. This is in support of the unopposed stipulation at page 10. Most components of a future test year revenue requirement are speculative. It's especially true for projected plan additions, which, it just basically gets all a bit murky. Have you ever heard of the term information asymmetry?
Yes.
Yeah. I was perusing some articles on future test years and came across that, and it was nice to have a little handle. And effectively, if I understand, information asymmetry is the notion that really the gas company is in complete control of the knowledge about potentiality for plant addition, and you all everyone else on the other side of it is really doing guesswork.
I think that's fair to say. I mean, especially my background is in finance. So when I make my recommendations about disallowances, for example, I'm trying to look at the big picture and saying, okay, big picture, I need to cut, I think they can cut a couple $1 million or $10 million or $100 million, but I'm certainly can't go in and say, you should do project A instead of project B, and none of the interveners. I mean, it's very difficult for any of the interveners to get down into that level of detail.
So shortly below that, you talk about the application when it was received, and you had major concerns, and one of them that the revenue increase proposed was excessive. I was just wondering what I mean, that's a significant word, excessive. Obviously, it got cut in half. It sounds like you were advocating to go even further with your own analysis.
Well, I was advocating to go further based on a lower ROE and capital structure. So I feel comfortable where we ended up, though, given the capital structure and ROE where we ended up.
Okay. Then you describe here at the page 11, lines 4 through 7, that the AG's office had concerns about the inclusion of speculative right-of-way payments in rate base. Can you expand upon that? I mean, don't want you to go too far into depth, but just sort of give a sort of broader description of what that concern is about.
Sure. The company pays right-of-way payments for being able to place its facilities on other people's lands, be that Native American lands or other parties' lands. And so they make payments. And in many cases, those payments they'll make a payment that it covers like a 20-year period. And so what they do is they may make a $20 million payment. That $20 million essentially is reflected in rate base. And then each year they will amortize $1 million of that. So the expense side would be $1 million, and each year that amount that was in rate base would be reduced by $1 million. In some cases, the right-of-way payments only cover 1 year, and they're relatively easy. When you have a future test year, you have lots of these right-of-way payments that are expiring, perhaps in 2022 or early in 2023. And the company had estimated what they would have to pay to renegotiate those right-of-way payments, and they included their best guess or their best estimates, but until they actually sign a right-of-way contract, no one knows what the actual numbers will be. And so that was the concern that I was expressing there.
Okay, and then that certain cash working capital components, can you expand upon that? That's the next item you have in that list.
Yes, that's interesting because the cash working capital was a concern, and this is actually an area where we made an adjustment that was in the company's favor. You might have heard the term lead lag study. There's something called a lead lag study, which is generally used in order to determine the amount of cash working capital a company needs. It's the difference between when they receive the revenues versus when they have a cash outflow. The company did that. We were fine with the cash working capital study. But then in addition to that, the company had made another series of adjustments related to how much cash they had in the bank. And actually, for some bizarre reason, it actually resulted in a reduction to their cash working capital. from a policy perspective, I don't believe that that additional adjustment is appropriate because I think everything should be captured in the cash working capital calculation. And so therefore, we reversed that out, which actually helped the company in this regard.
And the next item is the inclusion of unamortized costs for prior base rate cases. And I guess that you're talking about we've talked about already, the rate case expenses, was this basically?
Yes, they had actually, there were still some costs left over from, at least from the 19 case and maybe even from the 18 case that were not fully amortized on their books. So they had included those costs as well in their rate case costs. Not in what you showed me earlier, that was just for this case, but in other adjustments. And so I recommended that to the AG that those be eliminated.
And why is that? Because you explained to Ms. Hurst, and I didn't follow a second ago, that with an amortization schedule, if a subsequent rate case comes along, somehow then you would be precluded from prior rate case expenses under an. Could you explain? I didn't exactly follow what you meant by that.
Sure. Let me say that there's actually kind of two ways you can look at rate case costs. One is you can amortize, which means that, you know, every dollar they spend, they get to record on their books, and that whatever that amortization period is, they're going to be able to recover all of those costs. So if it's a 5-year period, they're going to be able to recover those costs over 5 years. And and if they file a rate case in 2 years, you're still going to let them recover the last 3. There's what's called normalization, which is you set a level of rate case costs, which you think is reasonable. And it's usually sort of tied to history, but it's not a dollar for dollar strict recovery of actual costs that are spent. So you could say, all right, every year I'm going to let you recover $200,000 of rate case costs. And I'm going to assume that by the time you file your next rate case, you're going to have enough to cover all your rate case costs. That's a normalization. And then you can do something that's kind of in between, which is you can allow them to amortize on their books the actual level of costs that they incur, but you're telling them that if you file a rate case before they're fully amortized, we're not guaranteeing that we're going to continue that amortization in rates going forward. So shareholders might be at risk for recovery of those costs. Now, in this case, there's a statement in there that they will amortize as they had requested. If it's not something that's specifically mentioned in the STIP, they are permitted to, for GAAP purposes, they're permitted to amortize whatever those costs are, like rate case costs, as they requested in the stipulation, which would be 2 years in this particular case. But it does not guarantee them recovery if they come in, let's say they came in a year. There's nothing in the STIP that would automatically guarantee them recovery of that remaining year's worth of rate case costs.
So we would
the
have
risk
to
is,
the commission would have to decide at that time whether or not to permit them to have to collect them?
yes.
And I'm assuming what you're describing is a process by which you're trying to avoid, I think, the circumstance that hearing examiner Hurst has expressed concern about over and over in this case, appropriately so, what seems like excessive rate case expenses.
Right, and pancaking of rate case expenses. So we only want to be paying for one rate case at any point in time.
Right, and Dr. Morin referenced pancaking, so that's good. I did note that when you were talking with hearing examiner Hurst, you noted that you had a lower return on equity in mind, but you didn't share the number. I won't force you to do so if you didn't wish, but I kind of wanted to say, why isn't she just telling us what the number she had in mind was?
Well, that's, Dr. Woolridge, that's his number. And he didn't file testimony in this case, but he files lots of testimonies. And I would encourage you to Google Dr. J. Randall Woolridge, pull up a recent testimony, and you'll see, the ranges that he's generally, I can tell you that he's, generally been in the ranges lately of, let's call it 8.75 to 9.1. I mean, that's sort of a general range for him currently.
Okay. At the top of page 12, you expressed a concern about the impact on low usage customers of the high residential access fixed fee. I assume that's sort of a conservation concern. It's penalizes those folks who use less. Is that what's going on there?
Well, yes, it does penalize the people who use less, and also some people, although I'm not sure there's really proof of this, but some people kind of equate low usage with low income customers, and that's kind of another reason why we try and keep that fixed charge as low as we can, because those customers are least likely to be able to afford an increase, and that's an increase that they really can't do anything about, because they can't save anything, by changing their behavior if you have a very high fixed access charge.
Your few sentences below that, you talk about extensive settlement discussions. Of course, one of the aspects of this case that Ms. Hurst and I will have to write about in a recommended decision is that there was, meaningful negotiation. So I wondered if you could just fill in a little bit what it was, what is an extensive settlement discussions? Just give a little bit more flesh to that.
Yeah, we had several meetings. We would couple of days where we got together. I then broke, and the intervening parties would go out and huddle, and the company would go out and huddle, and back and forth, and we would kind of horse trade, if you will. So
how long did that go on for? How long was that period of time?
I thought I saw in somebody's testimony that it was a matter of a couple of weeks. I don't really recall it being that extensive, but maybe it was. Maybe I've just blocked out some of it. I don't know.
Okay. Referring to sort of incentives at the top of 16, you note that the company will not be able to seek recovery of its regulatory asset associated with IMP related capital costs. And then you say, basically this provision provides the gas company with an incentive to forego another base rate change. There are stay out provisions, as you noted, but that wasn't something that was achievable in this case. I guess this was as good as you felt folks on that side of the ledger felt you could get. Is that the idea?
That is the idea, yes.
Okay. The question, you say here at 17, the stipulation will promote regulatory efficiency and preserve resources. The only challenge we have there, I'm aware that there was redirect that occurred. Mr. Haverly asked Mr. Jones some follow-up questions after Ms. Hurst and I, dug into Mr. Jones about the rate case expenses. So I realize what I'm about to say is, there's nuances, but it doesn't appear as though a whole lot of savings were achieved through this stipulation. And I guess what I'd like to know, there was an open meeting not too long ago in which the commission expressed real concern about stipulations. I understand that there are efficiency concerns, but number one, those weren't met here. But then secondarily, the commission has its own obligations to resolve these matters and be informed and feel as if it's resolved the matter in an informed fashion. And I suppose if you have a position that you'd like to inform the commission about, where do you fall in that debate? Like how useful stipulations are.
As somebody who loves to do the numbers and hates to do the tax, I love stipulations. And in this case, frankly, while, we still had a lot of hearing time and all, the fact is that I didn't have to write text, and neither did any of the other interveners. So there were savings, even if they were not from the company side. There certainly were some rate case savings, regulatory savings, and efficiencies in this case.
Okay.
I think stipulations are great in general. If you can bring if you have a couple things. One is if you have people that have done their homework before they started negotiating. So, you know, I would be very uncomfortable if you just had people who went into a room and didn't have their adjustments already sort of lined up and their numbers already lined up. In this case, we did. We knew where we felt we could go. So you need to have, you know, vigorous negotiations, and you need parties that have done their homework. If you have that, then I think stipulations are great, because they do allow you to produce a reasonable outcome without actually having to tell what your position is on certain areas that can be very sensitive for one reason or another. I mean, just think about all the rate cases that the commission may have to deal with, or I may have to deal with in the next year or two in New Mexico. And every time we kind of go on the record, we sort of box ourselves in a little bit. Everybody does. And that the commission does too. I mean, if the commission comes out with a decision and then in the next case, it deviates from that, that can cause some difficulty. So I think stipulations are great if everyone's done their homework.
Last question I have for you, Ms. Crane, is Mr. O'Donnell submitted some testimony indicating that based on his assessment of, you know, this gets back to that bench request question to which you responded as well. You know, looking at the projections from the 19 case, what was the outcome, you know, once time had passed, we can go back and look at that stuff. And his answer was they over projected by 13%. And I'm wondering if you agree with that, or if you have anything further to add on the subject.
Yeah, you know, I didn't really get a chance to look at his numbers in too much depth, but I will point out that his numbers are, I think he called them closings, plant closings. Okay. So I suspect that his numbers are gross plant numbers. I looked at net plant numbers in my testimony, because net plant is actually the number that's used to determine what your rate base is. It's gross plant, but also it's offset by accumulated depreciation. So whether or not the company is where they should be, you know, is a little bit broader than just the issue of how much plant did they put in the ground. And even my number, which is net plant, doesn't show the whole rate base picture, because there are other components of rate base. You know, there's gas and storage, there's cash working capital, there's regulatory assets. So you would really almost have to do a complete rate base buildup to know with 100% accuracy where the company ended up relative to where they said they would. But just given the net plant numbers, given Mr. Bullard's statement that they had done the 3 years of capital expenditures that they projected they would do, and given the O&M numbers from 2021 versus the O&M number that was in the last step, as I say in my response testimony, you know, I felt comfortable with the resolution that we made in the last case. And having said that too, just, I mean, COVID was such a great unknown. You know, it's kind of, nothing would surprise me, you know, that happened over the past year or two, given everything that we've all been through. I mean, people's habits have changed. People are working from home. That might affect residential gas usage, you know, more so than commercial. I mean, there's a whole host of factors, but I think when you look at the net plan and look at the O&M, I think we can be at least comfortable with the stipulation in the last case.
And a final question to ask you, what you were just saying made me think of this. I mean, you know, that business about we're in sort of uncharted territory with COVID and what that meant. I mean, I'm asking this as a question. I'm not offering it as a statement. I mean, in some sense, this whipsaw of macroeconomics that we're going through. I mean, how much is that going to be problematic for folks in your position to sort of see, like, what is normal? Because we aren't in anything that's resembling normalcy right now, right? Like inflation blowing through the roof in a way we haven't seen in almost 40 years. So how do we deal with this moving forward?
Yeah, I don't really have a good answer to that. I mean, we're just going to all have to learn together as we proceed. And see how it plays out. I mean, we'll continue to do everything we can to advocate for residential and small commercial customers, and everyone will just kind of advocate for whoever they're representing, and we're just going to have to kind of do the best we can. But you're right. I mean, it's totally unknown. I mean, so many things are changing. Technology is changing, and the macroeconomic factors are changing. Supply chain.
Geopolitics. I mean, right, you have the
Yeah.
Commerce Department and the investigation into the solar panels, which whatever. So, okay, well, that's a broader discussion, but
I guess we're all going to be employed for a while if we want to be. So that's good.
all right. Thank you very much, Ms. Crane. I appreciate your conversation.
Thank you.
Ms. Hurst.
Thank you. Hearing examiner, right? I have one question that just arose from your testimony in response to a question from hearing examiner Ryan. And it actually has to do with the numbers versus the text.
Okay.
Testimony that you said that you prefer to deal with the numbers. Indicating a stipulated testimony versus a pre-stipulation testimony with the text. Is that what that meant?
Yeah, I don't like to write. So if a case settles before I have to do testimony, that's great. Although there are cases that I do like in the last case, I did testimony, last New Mexico Gas Company case, I did the testimony, and then the stipulation happened, I believe, after the testimony was filed. So sometimes we have to do testimony and then settle.
And in the SPS rate case, you did both, right?
To be honest, I don't remember.
Well, it's subject to check. You filed direct testimony, and then you filed stipulation testimony. And I'm just wondering, because of the timing in this case and the party's request, I'm wondering whether or not you think that in allowing the parties, since they had already filed the stipulation, to not file direct testimony, whether or not you think I did a disservice to the record from granting that motion and not requiring the staff and interveners to file their direct positions.
No, I don't, because I think that once you get people's positions get hardened, once they have to sit down and put them on paper and go into detail as to how they got to a particular result. And so I think that, I don't think that it's helpful if you are going to end up with stipulation. I don't think that requiring full-blown testimony is necessarily helpful, because once you put that position out there, it can sometimes be more difficult to backtrack from that position. And as you know, the companies ask for lots of things, and generally speaking, they ask probably for more than they need. Advocates sometimes take very aggressive positions. And, sometimes we put things in there we don't expect to win. I think the settlement without testimony can lead to a result where you have two people that are kind of free to sit across the desk from one another and negotiate without that baggage that's kind of already out there in the record. So I think that's a plus. Having said that, though, I mean, I think if you can stipulate a case, that's great. That's preferable. If you can do it before testimony, that's even better. But you shouldn't stipulate a case just to stipulate a case. I mean, you should do it because you think you have a good result for everybody. So, I never go into a case with the feeling I really want to stipulate this case. I mean, we have to run through the numbers and see where we end up, and then kind of see how it progresses from there, if that's helpful. I don't know, maybe it's not.
No, it is helpful. I had not thought of the perspective that you talk about positions being hardened once they were in writing. You know, I basically just saw the you know, the timing aspect and then the potential negative of not knowing what the parties' pre-stipulation positions as potentially being you know, potentially detrimental to the commission. So no, I see your point. And the arguments that have been made in the past is it's usually a staff argument of, well, we don't have enough resources to work on our litigated case at the same time we're stipulating. So it's been a resource allocation issue.
Yeah, and I do think, I mean, you do run into that from a practical perspective. I mean, that's why it's good. It's good to start settlement discussions as soon as you have your numbers developed. You know, you try not to wait till a week before testimonies due to start
Right.
your settlement discussion. So if you have the luxury of time, yeah, that's even better.
And I've heard that is also a tactic that some utilities utilize, is not wanting to enter into settlement negotiations until close to the testimony filing deadline, for that very reason. You know, that, you know, let's push it till the end, and then, you know, they're going to have to concentrate on one thing or the other. So I guess the point is there's a lot of strategies here that the parties employ that, you know, that the hearing examiners nor the commission may know of.
True.
Very well. Mr. Gedko, do you have any redirect for Ms. Crane based upon my questions or hearing examiner Ryan's questions?
Yes, I have just a few simple items that.
Go ahead.
Ms. Crane, do you recall on page 11, you were asked questions regarding page 11 of your direct testimony in support of the stipulation, line 8.
Yes.
There it reads, over 50% of the remaining increase was related to labor increases. Is that 50% correct?
Yes.
Thank you. And do you recall that at one point it was stated 80%, but that was not corrected?
It may have been. I didn't hear that 80%, and if it should be 50%, which is in my testimony.
All right, thank you. Second, there was a question by hearing examiner Ryan regarding the initial position that the revenue increase was excessive. And you recall that you answered that you became more comfortable with what the final revenue increase was based on a change to the ROE and the capital structure. Do you recall that at all?
Yes.
And I may have heard incorrectly, but I heard that you stated that because of that you were uncomfortable with it originally because there was a lower ROE and a lower capital structure. Would I be correct to understand that you would become more comfortable if that ROE and capital structure were lowered and that you originally thought it was excessive because they were higher?
Yeah, just to be perfectly clear, in my number, which was lower than the number we settled for in the stipulation, my number reflected a lower ROE and a lower equity ratio than the company's.
Okay, thank you.
Okay.
And then the final one is just turning to page 10 of your direct testimony in support of the stipulation.
Yes.
On line 14, it reads, the NMAG believed that the revenue increase proposed by NMAG was excessive. Is is there a correction that should be made to that line?
Yes, NMAG, well, it should read, the NMAG believed that the revenue increase proposed by NMGC was excessive.
Thank you, and I'm sorry that no one caught that previously. That's the extent of the questions that I have on redirect. I will state to Madam Hearing Examiner whether a question of whether that last correction should be included in the corrected testimony that we are going to upload to Dropbox.
Have you already uploaded it?
No.
Okay, go ahead and make the correction then.
Okay, great. Thank you.
Thank you. Anything further, Mr. Getko?
No, that will be all. I'll just say thank you for allowing me those questions, Ms. Crane. Thank you.
Thank you.
Any party have any questions based upon my questions, Hearing Examiner Ryan's questions, or Mr. Getko's redirect questions? And hearing none. Ms. Craig, thank you again. Good to see you. Until
Thank
next
you.
time, you're excused.
Very good. Thank you. Thank you.
Very well. I believe unless we have any other procedural matters, we actually can recess 7 minutes early today. And we will resume tomorrow morning at 9 o'clock with New Mexico area witness, Mr. Gorman. Thank you all, and we are recessed for the evening.